Welcome to the European Market Open. A minute to go until the start of cash equity trading. I'm Tom McKenzie here in London, and here are your top stories. Markets shrug off mixed US economic data and a gloomy Intel forecast to eke out gains. Reports of Japan and the Netherlands joining the US in limiting Chinese access to chips tempers the climb. Touting the potential of Brexit amid rising criticism, the UK Chancellor Jeremy Hunt will lay out his plans to boost the British economy in a speech here at Bloomberg's European headquarters. He joins us for an interview later. Plus, the fallout continues. Adani company shares extend their rout as investors react to a report by US short seller Hindenburg Research. While the Indian conglomerate looks into legal action, almost $45 billion has been raised in less than 2 sessions. Let's check in on these markets then. Another very solid day stateside again, as we said in the headlines, looking past the mixed data when it comes to the health of the US economy. Yes, GDP at the top line coming in better than many had forecast, but underneath the hood, the consumer starting to look a little fragile. But it was really the drive coming through from Tesla, 11% gains for that stock in just the last few sessions. In fact, 11% gain yesterday, 50% gain in the last month for Tesla, and that powered the optimism looking through a very grim forecast from Intel. In terms of how the markets are positioning then, just in the first few seconds this Friday, you're seeing gains in Italy of 1.3%. We're waiting for the correct board to come through. We'll talk about the pound at some point as well, because yes, the UK Chancellor will be here in our European headquarters, touting the so far elusive benefits of Brexit. We'll see how he fleshes out his plans around building out this beleaguered UK economy. Let's check in on some of the mixed assets then. Adani Enterprise, yes, still front and centre for us. Very well read the reporting on this. Indian shares, they were closed. The markets were closed yesterday, coming back, and the losses just continue. This is one of their main conglomerate, at least the conglomerate, one of their main listings, currently down 14% in the session. Again, a $45 billion rout across the businesses. Now, Adani, of course, have come out and disputed very strongly these claims by Hindenburg Research. This continues, of course, this story. The impact not just for the world's or Asia's richest man, but of course also for the Indian economy. Futures in the US pointing lower by 0.6%. Not a great surprise given the run-up that we've seen in the tech-heavy index in the last few sessions. The benchmark 10-year, 352 yields, just up 3 basis points. A bit of selling coming across the curve stateside. And the yen strengthening 129, you're actually seeing gains of around 0.2%. This is on the back of stronger inflation that came out of Tokyo, 4%, the highest level since the early 1980s, just underscoring the pressure on the BOJ to address that yield curve control policy. Let's go over now to Bloomberg Markets reporter Valerie Teitel. Valerie, you are looking at the recent Treasury auctions, and January being one of the best months ever for auction demand. Why are Treasuries so hot at the moment? Is it all the yield story?
They are so hot at the moment, Tom. Yes, that's correct. Every auction this month in the U.S. Treasury market printed below market yields, meaning there was record demand behind it. And in fact, we broke a few all-time records in terms of indirect demand for some of these auctions. To me, it is all a reflection that the market and investors out there believe that these yields won't be around for much longer, and they're keen to grab them while they can. There's other things going on in the market, too. We know that January has been a record month for bond issuance, and there's been strong demand behind it as well. That goes across EM credit in the U.S., sovereign bond issuance here in Europe. There's also been some pretty chunky futures trades that have posted on the market. I want to take you through one of them that caught my eye. One of them is a quite a decent bet that the Fed funds rate is going to get to 2.5% by year end. That's around 200 basis points of cuts just out until December. There are some pretty decent trades thinking that the Fed is going to pause here in March, meaning that next week's hike would be their last, and that the yield curve is going to steepen quite quickly. We know that the yield curve has inverted as 2-year yields have risen sharply due to all the Fed hikes. But as the market looks ahead to the cuts that are coming, the yield curve could really snap steeper, and there has been some decent positioning for that kind of trade.
Okay, Valerie Teitel, excellent. Of course, our markets reporter there on the demand for US Treasuries that we've seen at least over the last week. Let's check in on a redhead crossing the terminal then as we get a little bit more clarity on the trajectory for this European economy. Spain coming out with prelim fourth quarter GDP rising 0.2%. That's quarter on quarter, and it's above the estimates of 0.1%. On a year-on-year basis, you're looking at fourth quarter GDP rising in Spain 2.7% year on year. Again, pretty decently above the estimates of 2.2%. Not a lot of movement for the euro, still under pressure, down about 0.1% for the single currency at 1.08. Let's switch focus to the US economy though. Beating expectations in the last quarter of 2022, slowing slightly, but still expanding at a pretty healthy clip of 2.9%. That's on an annualized rate. The mild slowdown is exactly what the Fed wants to see as it attempts to tame inflation. Joining us now is Anika Gupta, Director of Research at Wisdom Tree. And of course, we are bringing in as well our Bloomberg colleague who is across all of this when it comes to the US economy. Let's start with the question as to whether or not we are indeed now looking at a Goldilocks scenario for the US economy. Does this underscore those who are positioning for a soft landing? Does it give them more ballast?
Yeah, it certainly seems to give credence to that view that perhaps we're heading to a soft landing. But at the same time, there's a lot of mixed signals in the economic data recently and a lot of big question marks. You know, will the Fed, where is the Fed on its tightening cycle? Will we see cuts, or will they just hold interest rates at a high level and, weaken the economy? So certainly, I think the soft landing thesis is getting a boost, but there are plenty of investors out there who say stay cautious on risk right now.
Okay, so the soft landing thesis getting a bit of a boost. It was a mixed picture, and it is hard to get a straight and clear trajectory when it comes to the US economy, because yes, US jobless claims unexpectedly coming in lower, so strength again for the labor market, that's been consistent, but then the consumer is starting to soften. So the top line in GDP, pretty decent, as we said, 2.9%. The consumer is starting to look a little fragile.
Yeah, absolutely, and clearly, you look at the Intel reports today, a grim forecast, the shares are selling off. I think the earnings picture, it's still looking a bit weak, but relatively, that's what people expected. So you're not seeing a lot of movement from that. And I think, at least the investors that we talk to, the one thing I've really been surprised is even if we're in that soft landing scenario, you're not seeing investors say, now's the time to buy, I'm bullish, let's get into risk. Everyone's still quite, skeptical about how it's going to play out.
And to that point, the JP Morgan survey finding that just 35% of their clients plan to add stock holdings in the coming weeks. When it comes to the earnings picture then, again, tech just rallying, it's seeming looking past the travails of Intel, but there's a real question mark about PC demand. And I just wonder if that's an idiosyncratic question, an idiosyncratic story for Intel as they try desperately to restructure this business, or if there is a broader read across, if there should be a broader read across for tech.
Yeah, I would say the interesting thing about tech right now is how much it's rallied this year. Everyone has expected, the softening, and perhaps that's been priced into the big losses that we saw at the end of last year. And now you're seeing things start to come back, and the narrative that, look, we knew it was bad, but it's not as bad as we thought it was going to be, is what's starting to filter through.
Okay, Lynn, thank you very much indeed. Let's bring in Anika Gupta now, Director of Research at Wisdom Tree. And Anika, thank you for joining us this morning. Let's start with your views then. Do you have more clarity? Do you have a greater grip on the trajectory for the US economy? Are you more reassured about where things are heading?
Well, based on the recent macroeconomic data that releases we've been getting, I think the picture is getting a lot more clear. We are seeing inflation beginning to peak. We are seeing growth beginning to cool. So that does open up the scenario of a more softer landing, which really moves in favor of the Fed's next decision of actually increasing rates by just 25 basis points. And I think that's on the back of the labor market still remaining fairly resilient. So I think a 25 basis point rate hike and moving it across the year, seeing a much softer landing is how we position, the U.S. Moving around for 2023.
So you're in the soft landing camp, 25 basis points at the next meeting. Did they then pause, Anika? Is that your analysis? And if they pause after February, how do you position around that?
Well, it's a really tricky situation because a lot of, obviously, domestically, we're seeing a bit of cooling taking place. But let's not forget, at the end of the day, inflation from headline inflation, which emanates from the energy side, still remains a big uncertainty. We do see chances of energy prices actually moving much higher moving into the year, and that could continue to pose a risk for headline inflation numbers. So I think the bond markets clearly are pricing cuts going forward. I think based on the resilience that we've seen in the US economy, I think we might end up doing something similar to what the Bank of Canada has just done, of holding rates exactly where they are at this point in time after the 25 basis point rate hike, and just seeing how the economy actually progresses along.
The outperformance of European stocks to US, 20% since what, around mid-September. Do you want to fade that rally? This is an 8% overperformance versus US stocks within that time frame. Do you fade Europe?
I would fade Europe for the interim period. And the reason is where we're really seeing that strength is in pockets of underperformance of 2022. So be it the consumer discretionary, semiconductors, luxury goods, retailing, these are the sectors that are doing really well today. And added to that, the small cap sectors. So it's precisely the sectors that underperformed in 2022 that are outperforming right now. But it doesn't make a lot of sense, because if you look at it, what's very important for Europe is, yes, the reopening of China is more beneficial to Europe. But if you look at it from a revenue perspective, Europe earns twice the amount of revenue from the US as compared to China. So for the US to have a soft landing or manage to actually avoid this recession is more important for Europe than the reopening of China. And what you're seeing in this current rally of stocks is semiconductor stocks that have, the maximum exposure of like more than 20% to the Chinese economy, virtually, very, very little exposure to the Chinese economy. Both are rallying north of 20%. So there's clearly a mismatch, and that needs to correct. So I think this week we're going to see a lot more restrictive policy come in with the Fed, ECB actually going ahead with their rate hikes. And I think that's when you're going to see the dust settle. And after we see a bit of cooling of this cyclical versus defensive rally, that's when we'll start to see, the true correct upward momentum actually take place for European equities.
Okay, interesting. So maybe the dust settles after those important decisions of next week. Just looking back on 2022 in terms of a guide for the rest of this year, particularly when it comes to energy and the EPS growth out of the energy sector for Europe, accounting for about 2/3 of that EPS growth. Does that outsize role of energy, does that continue to play out towards the end of this year, Anika, given your deep expertise on energy?
Well, I do believe it's going to be, it's an important cash cow within the EPS earnings growth. So investors continue to rely on the energy sector because obviously over the course of 2022, we've seen sharp rate hikes. The energy sector has benefited investors with their generous shareholder returns. They're continuing with extreme capital discipline, which is what investors like. They're the only sector that is actually dominating with positive earnings growth. So I think eventually you will see investors continue to lean against the energy sector. Now, obviously, we did see a bit of a mismatch towards the end of the year where energy stocks actually outpaced energy prices. So they were in for a correction, which we've actually seen play out. But you need to keep in mind, 2023 is not about the multiple correction. It's all about the earnings correction. We've seen valuations adjust over the course of 2022. 2023 is all about earnings contraction. And you're going to see less of that within the energy sector. You're going to see more of that within the cyclical sectors. So I think, that's the point to bear in mind.
More resilience as we face up to a potential earnings recession. Let's briefly just get Lynn's thoughts before we let you go. Lynn Thomason, of course, of Bloomberg. Just a very quick preview, a big week across earnings next week. What are you and the team going to be looking for as Anika there points to that importance around resilience if we are facing up to an earnings recession?
Yeah, I mean, I think obviously the really interesting thing for us is the job cuts. Who is cutting jobs, how deeply, and how do investors react to that? I mean, I think one interesting thing is that a lot of companies have been cutting jobs, but investors aren't reacting negatively to that. In a lot of cases, they're buying those companies in the bet that, it's a sign of resilience and companies are, tightening their belts to weather the storm that's coming.
Okay, Lynn, thank you, as ever. Really important to get across some of these key themes across these markets, and always excellent. Anika Gupta, Director of Research at WisdomTree. Both have a great weekend, and thanks for your insights. Coming up, Intel has given one of its gloomiest quarterly outlooks in its history. But the CEO says the chip maker remains steadfast for the long haul. We have the earnings breakdown next. This is Bloomberg.
Coming out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah. And
so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
News breaks. No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome back. Intel shares plunged in post-market trade after it forecast a surprise loss in the current period and missed sales range estimates. The chip giant also gave one of the gloomiest, grimmest quarterly forecasts in its history. Bloomberg Quick Take's Alex Wegg has been digging through the numbers for us. What is causing the drag at Intel?
At this stage, it's basically computers, personal computers. We saw a lot of spending during the lockdowns as some people had a bit more disposable income. Some of that money was spent on electronics. Now, as personal finances become a little bit more squeezed, there's not as much spending on that. There's therefore a huge amount of inventory that the makers of computers have. Intel makes the chips for them, is not able to sell as many, and that's really what's been dragging things down.
I mean, it shouldn't come as a huge surprise to investors, should it? Given what we saw during the pandemic, people stocking up on PCs and laptops, that there is going to be that drag that plays out?
I think the scope of the decline has really been the shock here. You know, in the current quarter, the March quarter, the market's been expecting about 14 odd billion dollars in revenue. Intel's now forecasting between 10.5 and 11.5. That's a pretty significant miss. Compounding that, the profitability is also likely to be a lot lower than in the previous year, about 14 percentage points down. That is pretty painful for a company that was famous for its really juicy profit margins in the order of 50%. So it's a big hit, a bit of a shock. Pat Gelsinger's got a lot to do.
Yeah, and he's got some big spending plans as well. The other big story, of course, that Bloomberg's been reporting on heavily is the decision, it seems, is going to come through today between the Netherlands, Tokyo, Japan, of course, and the US in terms of further restrictions, aligning on restrictions to China. How significant is this? What are the details?
It's kind of hard to overstate how significant this is. It's a massive, massive deal. This is like at the center of so many geopolitical tensions right now, obviously excluding the war in Ukraine, but the tensions between the US and China, so much of it comes down to chips. What the US has done is really restricted the ability of China to buy chips themselves. What they're doing now is restricting pretty extensively China's ability to buy the equipment to make chips themselves. One company in particular, ASML in the Netherlands, they make these massive machines. They're the only company in the world that does them. Extreme ultraviolet lithography. They can etch circuit patterns in the 3 to 7 nanometers. That makes the cutting-edge chips that China really wants in order to become technologically self-sufficient. If you're going to do cutting-edge stuff in AI, you need that gear because you need to have the best chips. The US, by forging an agreement with Japan, which also makes some equipment, and the Netherlands, of course, the home nation of ASML, massively throttling China's ability to be at the cutting edge.
And interesting to hear previously from ASML's CEO saying, look, eventually China is, if we get restricted, if they are not able to bring in these UEV lithography machines from us, they're going to have to start to build their own. There's a big gap, obviously, the experts think, but that is the pushback from some of these executives.
Easier said than done, right? Yeah. Because it's not just a case of being able to build, well, we'll build our own machines and develop them ourselves. You then also need the components to go into those machines. You know, the supply chain is vastly complex. The expertise is very, very difficult to generate and can take a long time.
Always excellent. Alex Webb, thank you very much indeed of Bloomberg Quick Take. Coming up, the UK's Chancellor of the Exchequer is expected to outline plans to tackle sluggish growth in a speech today. We will bring you that and the details. This is Bloomberg.
We have only 8% of the ocean protected today. And our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least, 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back. Now, the UK's Chancellor of the Exchequer, Jeremy Hunt, is expected to outline plans to tackle sluggish growth and economic inactivity in a speech later today here at Bloomberg's European headquarters. Let's get more then from Bloomberg Opinions' Therese Raphael. Therese, what is the Chancellor expected to say in this address?
Was expected to say that confidence in the future starts with honesty, present moment. So I think we're going to see him try to do two things. One is manage expectations about the economy. He's going to have to be very frank about the just challenges facing the government right now. But he's also try to reassure people that the government has a plan for growth and a plan to tackle problems like productivity.
And does that plan include tax cuts, Therese?
I think we're going to have to wait a while for tax cuts, and that's going to come to the immense disappointment of a wing of the party that really believes that is the only way to restore growth in the UK economy. They will point out that the share of taxes paid by 10%, 5%, 1% of taxpayers has gone up over the years, and that these are a mobile part of the population. People vote with their feet. And, you know, I think he say that he wants to lower taxes, but he can't do that under current circumstances. And of course, we know why. Productivity rates have declined. We have 250,000 fewer people in the workforce for various reasons. Some may be to do with health issues, long COVID. Others have taken early retirement. That's a big problem for the government. There has been increased immigration. We've lost a lot of EU citizens, and there are still lots of frictions and barriers in the economy that are preventing that kind of growth. So while the recession is, if there is one, shallower than many expected, the recovery feels very anemic. So Hunt's real challenge now is set out exactly how do they tackle the productivity problems? How do they return to growth? And that's how do they do it without substantial tax cuts in the term, which is what many Tories are calling for now.
Okay, Bloomberg Opinions, Therese Raphael, thank you very much indeed for a preview of that speech, which will, of course, take place here at around 9:20, 9:30 a.m. here at Bloomberg's European headquarters. Anna Edwards will be speaking to the Chancellor in an interview about an hour after that, around 10:30 a.m. That is certainly something to stay tuned for. Across your markets, the benchmark here in Europe, just down 0.1%, a bit of profit taking, it seems, particularly after the run-up that we saw yesterday on Wall Street. Futures in the US also pointing lower by about 0.4%. Let's get the Bloomberg Business Flash now with Laura Wright. Laura.
Thanks, Tom. LVMH has posted slower sales growth in the fourth quarter as pandemic restrictions in China hurt spending in the crucial market. Despite that, Europe's most valuable company still reported sales growth at its key fashion and leather goods that beat estimates. FTX advisors say the collapsed crypto firm owes a long list of creditors, including the likes of Goldman Sachs, JP Morgan, and Wells Fargo. Bankruptcy court documents show thousands of entries with some kind of connection to the exchange. Deutsche Bank, HSBC, and MUFG are also on the list. The disclosure does not reveal details such as the size of any exposure. US retailer Bed Bath & Beyond has edged closer to bankruptcy filing after saying it received a default notice from JP Morgan and doesn't have enough funds to make payments. A regulatory filing reveals creditors are demanding immediate repayment after the company breached the terms of a credit line. It listed around $2.1 billion of obligations as of November. That's the Bloomberg Business Flash. Tom.
Laura Wright here in London. Thank you very much indeed. Coming up, Intel shares plunge in late trade after reporting a miss on sales and a grim short-term outlook. We did touch on that story. We will be getting more. Across your markets, you are seeing a bit of selling pressure across bonds, treasuries, 10s, 353, yields up close to 4 basis points. Similar picture here in the UK with gilts. Futures in the US lower. Stay with us. This is Bloomberg.
somebody says, I want to be, a person has an impact on society, what would you recommend that somebody do to train themselves and to work their way up to be somebody that's impactful on society?
Well, I think the first thing you've got to believe in something that you really care about. You know, I've been fortunate that over the course of my career, I've come up with things that have mattered to me, and I've pursued them. You know, the best advice I ever got was from Mike Bloomberg. And he said to me at one point, he said, show me somebody who's never lost, and I'll show you a loser. And I believe that if you believe in something, go after it, take risk. Obviously, they should be smart risks, but they should be around things that you really care about.
So you would see your legacy as being actually target ALS and helping to moderate the impact of ALS, if not curing it.
That's my final legacy. I'm proud of some of the other stuff that I've done as well. Transformation of New York after 9/11. I'm also incredibly proud of a lot of the companies we created at Sidewalk, but I feel like I've done a lot.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Markets turning a little lower, mixed US economic data and a gloomy Intel forecast, of course, and reports of Japan on the geopolitics and the Netherlands joining the US in limiting China's access to chips, tempering some of the climb. Touting the potential of Brexit amid rising criticism, the UK Chancellor Jeremy Hunt will lay out his plans to boost the British economy in a speech here at Bloomberg's European headquarters. He's going to join us for an interview later. Plus, the fallout continues. Adani company shares extend their rout as investors react to that report by US short seller Hindenburg Research. While the Indian conglomerate looks into legal action, almost $45 billion has been erased in less than 2 sessions. Let's check in on these markets then. 30 minutes into trading day this Friday. A little bit of profit taking, it seems, around the edges at least. You are range bound now across the European benchmark. A very solid session again, particularly driven by technology. Tesla up yesterday 11%. The Nasdaq adding another 2% gain. The optimism within tech seemingly overlooking a bit of a grim forecast when it comes to Intel, but also that mixed picture when it comes to US data. The FTSE 100 currently just up 2 basis points. Energy is playing a role there. Brent and WTI are up. Here you go. Energy gaining top of the list, 0.6%. Pretty muted though. Construction and materials also gaining 0.4. About half the sectors in the red so far this morning. Retail leading, currently down 1%. Part of that will be the earnings story as well. Margin pressure, the impacts, of course, of what's been happening in China, even as some executives point to a brighter outlook for the rest of the year as that economy reopens. Let's check in on some of the individual corporate stories as I talk about earnings, but also some deal making, potentially deal making, certainly investment around the supermarket and grocer space here in the UK. Long been a point of speculation, Sainsbury's, and this is a business that has seen a bit of investment injection from a family-run conglomerate of retailers here in the UK. The owners of Costco are taking a more than 3% stake in J. Sainsbury's, say they are open to adding to that stake, carrying 5.5% on the back of that. H&M disappointing earnings again. That is part of the margin squeeze. It's a part of the build-up in inventories, the cost as well of cotton and those input prices. That is a drag on that business. Restructuring, of course, and taking a hit from having to pull out of Russia and Belarus, currently down a little over 6%. LVMH within the luxury space, again, a drop aligned with some of their rivals like Richemont when it comes to the December period, that last quarter, particularly out of China when you had, of course, surging COVID and still those restrictions in place. They are pointing those exits to a much brighter outlook as Chinese consumers come back online. Currently down 0.4% for Louis Vuitton, the Louis Vuitton owner. Right, Intel shares plunged in post-market trade after it forecast a surprise loss and missed sales range estimates. The chip giant also gave one of the gloomiest quarterly forecasts in its history. Joining us now is Ray Wang, principal analyst and founder of Constellation Research. Ray, I really want to get into the Tesla story with you, but let's start with Intel then. Is this just a singular Intel story, or is it a broader concern for the tech sector? Yes, PC demand is falling, but surely that's going to come back.
Demand's going to come back. The chip market, and since September, has been in a glut. Almost every company has been hoarding chips. And by hoarding chips, they have not had a good supply chain forecast in terms of understanding demand. And it's not just Intel. You're going to see it in other areas, but not as acute as Intel. And that's why they've got a gloomy forecast, because a lot of people held on to a lot of chips for way too long.
And Ray, part of the concern as well is the cost that is being put into this restructuring plan by Intel around the factory build out, around trying to be essentially a TSMC of the United States. How much faith, how much conviction do you have in that turnaround plan?
Well, Pat Gelsinger is a very skilled leader, and I think if there's anyone that can pull it off, it's going to be Pat. There's a lot of work to be done. They've got to get into the 5 nanometer and then the 3 nanometer chipsets, but there's going to be a lot of demand if they do that. Fabs aren't something easy to build. They usually take 3 to 5 years to get up and running. It's going to take them some time. So he's buying time by talking about where they're going to be in terms of their forecast, at least for the near future. But the Mobileye spinoff actually has helped them in the long run to stay more focused on their core business, which is really getting chips out and the chips that companies want.
Okay, Ray, let's go to Tesla then. Wow, what a 30 days it has been for this company, adding about 50% in terms of the rally. Of course, the context is still down about 40% over the last 12 months. You have a price target. You're a bull on this stock. You've got a price target at 160. In fact, you've got a price target $200 a share. It's currently at 160. How does Tesla get from 160 to 200?
We're going to see that because the EV market is growing much more quickly than the ICE market. If you looked at combustion engine cars, they fell 9%. EVs are growing much more quickly. Tesla has production. That's the thing people don't realize. When you look at what they're able to do, the capacity to every one of the gigafactories, whether you're in Berlin, whether you're in Austin, whether you're in Shanghai, these factories are able to crank out millions of Teslas. And that's the important thing. And they've got vertically integrated battery operations to do that. But once again, the valuation of Tesla is not just being a car company. They've got the capability, they've got the imaging data to be able to deliver on potentially what they might announce at their Tesla Day for autonomous vehicles. They've got the capability right now to do self-insurance. A lot of people are testing that out right now. And more importantly, if you think about Tesla in the longer run, it's also about the energy management conversation that they haven't talked about in quite some time. So all those are coming into play, plus towards the end of 2023, we're going to see the semis come out, and we're also going to see the Cybertruck. And that piece is going to actually cause another explosive growth as they get into the light truck market and, of course, the long-haul truck market as well.
Okay, so there's a pipeline and it's that market dominance. Ray, when it comes to Microsoft, does your buy call on Microsoft a little fragile? Does it look fragile? Are you concerned given that outlook around cloud demand?
So there is this declining growth in cloud demand, but keep in mind, there's 3 players in the space: Microsoft, Amazon, and Alphabet. And Microsoft has a really good lock on large enterprise corporates. That, along with the fact that they're going after OpenAI and their generative AI piece, is going to actually create a lot of growth for them as people start thinking about improving and increasing their workloads onto AI. They're going to be thinking about Microsoft. And of course, they're also waiting for the Activision deal to complete. So.
Ray, what do you make of the job cuts across technology? Is this cutting the fat? Are these going to be leaner, meaner operations after this? Is there more headcount to go? And what is the resilience of the talent market now?
It's a great question. I mean, we're hearing a lot in the press, tech layoffs, right? We've had 1,400 rounds of layoffs, 220,000 jobs in 2022, 27,000 workers announced so far this year. But in the big picture, tech companies traditionally have let go of their bottom 5% every year. That did not happen since 2019, since the pandemic. So it's been 3 years of that. What we have been seeing, though, is workers that have been let go have been able to find jobs in less than 60 days. It's a little bit longer, almost 90 days now, but before we had 3 job openings for every applicant. We're probably down to 1.5 for every applicant right now. So while that sounds concerning that a lot of tech workers are going away, they're also going to other industries. Companies that could not afford to have paid the same amounts as the digital giants are now being able to grab them. Public sector is getting tech companies, and of course, startups that wouldn't have been able to afford the salaries that these large digital giants were paying are also now able to access that talent.
Okay, Ray, it is comforting to hear that a lot of these people who are being laid off are of course, finding positions pretty rapidly. Where are you seeing, what do you want to be sticking clear of then? You've talked about your optimism, relative optimism around Microsoft, Tesla. Are you sticking with the big blue chips within the tech space, or do you want to be taking on a little bit more risk now as the speculation about Fed cuts, or at least a Fed pause, picks up pace? What are you avoiding?
I'm still not convinced that we're going to have Fed cuts in the way that we're looking at. I think the Fed has to hold its line, and it's going to wait to the very, very end to do it. But if that does go well, I'm also looking at other areas in critical infrastructure, anything around analytics, automation, AI, cybersecurity, and cloud. Those are going to be strong. Take ServiceNow. They beat their numbers, and they're actually operating in Silicon Valley. We talk about the Rule of 40. They're operating close to the Rule of 60, and they've also made a commitment not to fire anyone in 2023. So you're seeing that take off. And of course, companies like UiPath, companies like Adobe are companies that we're looking at. And then, of course, we're going to see what happens with Salesforce.
Smart analysis. Fantastic stuff. Ray Wang, principal analyst and founder of Constellation Research, joining us out of San Francisco. Have a great weekend. Thank you for your time. Coming up, Adani Group says the report from short seller Hindenburg Research is, quote, bogus. The group's shares continue to come under pressure. More on that story just ahead. This is Bloomberg.
Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today.
Welcome back to the Open. Happy Friday, 42 minutes into the European trading day. Very modest gains now, about 0.1% across the European benchmark. It's been a bit of a choppy session. The gains, of course, of yesterday on Wall Street, particularly led by tech, and the NASDAQ looking through a bit of mixed picture when it comes to the GDP data out of the US. NASDAQ futures, though, pointing lower by 0.6%. Let's get the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. Chancellor Jeremy Hunt is to set out plans to boost the UK's growth rate in a major speech at Bloomberg's European headquarters this morning. Hunt is expected to reject calls for tax cuts while arguing the country can use its Brexit freedoms to improve its sluggish growth record. The UK remains the only G7 economy with GDP below pre-COVID levels. Bloomberg Television will speak to the UK Chancellor after his speech. Don't miss that conversation, 10:30 a.m. UK time. Bloomberg has learned that Japan and the Netherlands are set to join the US in limiting China's access to advanced chip-making machinery. We're told that officials from the two countries will conclude talks on the details as soon as today. The joint effort will further undercut Beijing's ambitions to build its own domestic microchip capabilities. The US economy beat expectations in the final quarter of 2022. GDP rose at an annualized pace of 2.9% and 3.2% in the third quarter. Some economists said there were warning signs in the data, though, especially weakening consumer demand, to suggest that a US recession remains a big risk this year. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom.
All right, here in London, thank you very much indeed. Let's switch focus to a banking giant with a footprint, of course, here in the London and Hong Kong as well. HSBC shares have become the most overbought in 3 decades. On at least the exchange and the listing over in Hong Kong. Investors are piling back into the retail lender thanks to, of course, the brighter outlook from China reopening. Shares have rallied 50% on the listing in Hong Kong since the lows of October 2022. So just highlighting that story for you. The listing here in London up about 35% since mid-October, but a turnaround certainly in terms of the fortunes of HSBC benefiting from an expected flow of capital from mainland China into its branches in Hong Kong. Now, shares of Adani Group companies, they are continuing to tumble. Very different story. After a report from short seller Hindenburg Research, losses accelerated even after Adani disputed the allegations in a call with bondholders. It has pledged to release a detailed rebuttal later today. Let's get the latest then from Bloomberg's PJ Sanjay in Mumbai. Sanjay, we're seeing then some double-digit losses in terms of the declines in Adani shares. They're going to come out with this rebuttal. Is it going to help?
So already the damage is done. So the Adani Group companies have lost around $45 billion worth of wealth, and some of the key stocks have lost double digit, and the sell-off continues. So the critical thing, the context is that today is the day when Adani Group's flagship company, Adani Enterprises Limited, is going to hit the capital market with its follow-on issue for retailers. Of course, it has managed to allot shares to anchor investors, high-profile anchor investors on 25th of January, which is the day which Hindenburg has launched its scathing, report, which alleged tax theft, corruption, money laundering, and a lot more stuff. So we are expecting one more rebuttal. We are expecting that will come before, after the closure of FPO, which will be ending on 31st January. We're not expecting this today because there were multiple statements issued by the legal head of Adani and
completely
the CFO
engulfed in flames, and there are.
Yeah, and of course, worth pointing out that Adani and Adani executives have said that these claims are totally unfounded, and as you say, we await for that full rebuttal. There's a broader read across, though, for India Corp, essentially. The investment thesis for India has been shaken by this. Is it going to be sustained? How concerned are Indian corporates, Indian executives about this more broadly?
Oh, that's a long-ranging question, but I don't think this is not the first time where Hindenburg Research like report coming. Last year there was a report by a research firm, Credit Sites, which flagged the exactly same thing, and they've also said about there's been potential default by the conglomerate. Later, that company watered down their stance. Of course, they stuck to the core thing, but nothing happened. So to answer to your question, of course, in case if this all been proven right, then there could be a far-ranging impact and implication on India investment stock. story, but for now it is still intact because it has not been proven. It's just an allegation, and which has been denied by the Adani Group executives, two executives in different manner, and they have also threatened that they will be taking legal action against Hindenburg, research under India laws as well as US laws. So the story is developing, and one will have to wait and watch.
Yeah, it's got a lot further to run, hasn't it, this story? Always excellent. PR Sanjay, thank you for bringing us the latest on the misfortunes, at least the controversy around Adani Group. That route now crossing $50 billion. Some of the stocks there within that group plunging by their daily limits. Talking of stocks and individual names, let's bring to attention some of the earners, some of the news and around the news flow around at least investments and potential deal making in the grocery space. This is interesting. Family-owned Bestway Group buying a 3.45% stake in J. Sainsbury's. It's the second largest grocer in the country, Sainsbury's. Bestway Group, the owner of Cost Cutter, amongst others, and saying that they are open to increasing their stake at some point. Shares rallying on the back of that news. Speculation about the future of J. Sainsbury. H&M, it's a very different story. Earnings coming in, pointing to a contraction around margins and concerns about high inventory. Stock down 6%. Slower sales growth in the fourth quarter, linked to partly the pandemic restrictions in China, but also restructuring of this business. LVMH gaining 0.5%. They did see a bit of slower growth as well. That's the story linked to China. Sales rising 10% in the last quarter. They are pretty optimistic about the future, though, as Chinese consumers come back out and start to spend. And talking of LVMH, we are going to be getting the latest from one of their executives, reporting a slowdown in the fourth quarter, again, on that slump in Chinese demand. They think that's going to be short-lived. The luxury giant says the year has started well, though, as those restrictions ease. We are going to hear from an LVMH executive, the CFO. That is next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
From this low
amount of business, we have recovered very significantly in the months of January. Obviously, it's only 3 weeks, and it's hard to make a trend of 3 weeks. But we can be really optimistic that China has actually turned the page of the disruption of the pandemic, and we can look forward to the business with quite some optimism.
LVMH CFO Jean-Jacques Guiony speaking exclusively there to Anna Edwards. Now, for more on Europe's most valuable company, joining me now is Bloomberg's European luxury reporter, Angelina Rascouet. Angelina, what are the main takeaways then from these results out of LVMH?
Yes, indeed. I mean, basically, when it comes to the fourth quarter, they were heavily impacted, like their peers at Richemont, at Burberry, by performance in China. I mean, China has been a crucial market for luxury groups. And in December, what happened is that, the country pretty much went from lockdowns to a complete U-turn. But then the COVID wave hit. And so what happened is that a lot of the customers really couldn't go to the stores, but also their workers were ill. So basically, that's what led to, Asia being down 8% on the quarter. However, as Jean-Jacques Guiony was quick to point out, the start of 2023 has gone well. Yesterday, Bernard Arnault told analysts and reporters that, for instance, trends in Macau, which is a crucial, which is a big tourist destination for the Chinese, are right now are incredible. So basically, they are seeing, so far encouraging signs about the recovery. And otherwise, among some of the milestones that are important is that Louis Vuitton, for instance, last year surpassed the 20 billion euro in sales, and that's obviously their biggest label. So generally, LVMH doesn't break down financial numbers per brand, but here they did.
Okay, so we talk about the domestic market there with Macau, of course, and the reopening. And then there's the question of the all-powerful and the cash-rich Chinese tourist coming here to Europe. How much of that spend is going to be beneficial in terms of lifting the line for LVMH?
Yeah, I mean, that's a big question mark. Obviously, pre-pandemic, the Chinese tourists would love to come to Paris and Milan to buy, French labels or Italian labels. Right now, they were saying basically the Chinese will probably initially travel in Asia. However, it's probably going to take a bit of a longer time for them to come to Europe, even though there's pent-up demand, but there's limited airline capacity. So initially, yesterday, Jean-Jacques Guiony was telling us that he expects more the wealthy individual Chinese tourists to come rather than the big groups of Chinese who used to come and benefit from package stores. So he reckons the massive return of Chinese will probably happen in 2024 rather than this year.
What about the ability to pass on some of the prices? This is a question for my producer, the show producer Pooja. She wants to know if her Dior handbag is going to cost more again this year.
Well, we put the question to Jean-Jacques Guiony, and indeed, what he said is that the labels across the board, they increase prices, driven by inflation at the start of 2022. And however, he said they are less likely to do so in 2023. I mean, they're still leaving, some room for of maneuver. But basically, he says you cannot do price hikes every 3 days because it's disruptive for the customer. And also, you also have to be careful because it's risky. And also, when you do price hikes, you have to justify these price hikes. So you're doing a lot of marketing, promotions, advertising, which is also costly. So it's a tough balancing act between pricing and volume. So you also don't want to lose on volumes.
Angelina, really fantastic. Thanks so much. Angelina Rascouet on those LVMH earnings and, of course, the prospects for that business as Chinese consumers and Chinese tourists come back. Let's briefly check in on these markets then. It's been a bit of a turnaround in terms of sentiment, turning a little bit more positive across the benchmark. We can have a look at some of the individual stories as well. Across the benchmark, gains of about 0.1%. Germany posting 21 points, adding 21 points. Over in France, the CAC 40 trading at 7,100. And the FTSE 100 getting a bit of a lift from the energy space. Brent and WTI are up. We look ahead, of course, to the US session after Wall Street closed, particularly the NASDAQ, up around 2%. Will that optimism around technology continue, or will the focus shift back to the prospects of what is happening at the Fed next week? Mixed picture when it comes to GDP data, of course, out of the US, but the jobs market remains very tight indeed. That is it for the European Market Open. Surveillance Early Edition is up next, in which we're going to hear from UK Chancellor of the Exchequer. Stay with us. This is Bloomberg.
what do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Here's what's coming up on today's programme. The chips are down. Intel gives one of the gloomiest forecasts in the company's history after reporting a sales miss. We'll bring you the pre-market share price in just a moment. The US economy posts a mild slowdown at the end of 2022, but beats expectations, providing encouraging signs for the Fed's fight against inflation and touting the potential of Brexit amid rising criticism. Just 20 minutes from now, the UK Chancellor of the Exchequer, Jeremy Hunt, will lay out his plans to boost the British economy in a speech here at Bloomberg's European headquarters. He then joins us for an interview the following hour with Anna Edwards. Let's check in on these markets then. A bit of a turnaround in terms of sentiment. It's been a bit of a choppy trading session across Europe. We'll have a look at the European benchmark shortly. We are bringing you, of course, the story when it comes to Adani. Those equities, those stocks, as part of that conglomerate, remain under pressure. The Indian markets were closed yesterday, so it's a bit of a catch-up reaction. And, of course, this group and executives have said they're going to look potentially at legal action against Hindenburg Research, and also pushing back very, very strongly on those claims of mismanagement and fraud that have been put forward by that research group and that short seller. But nonetheless, the stocks are under pressure. This is one of the biggest companies within that conglomerate that is listing. You can see that reflected. Nasdaq futures pointing lower by 0.6%. A bit of profit taking, you would assume, given the run-up that we're seeing. Gains of 2% on the close yesterday, an 11% rally for Tesla, and broadly within the tech space, at least within the investor community, yesterday looking past the travails of Intel. And that's a story we'll unpack in more detail for you. A sell-off across the Treasury markets, just modestly, yields up 4 basis points on the 10-year, 353. Japanese yen strengthening 0.3% as inflation in Tokyo comes to early 1980s highs, just again putting pressure on the BOJ to reconsider its yield curve control. Across the map then, modest gains here in the UK, almost flat, just up about 0.1%. There is an energy component here. The sectors, in terms of some of the leading gains, energy, Brent is up about 0.8% the last time I checked. The DAX gaining 0.1%. Over in France, a similar picture. And the geopolitics back in focus again with the news that the Netherlands and Japan will be aligning with the US on further restrictions of chip technology to China. The FTSE Mid putting in a slightly better performance, gaining 0.2% over in Italy. Let's have a quick look then at the Intel pre-market price. Oh, look at that, down more than 10%. Again, a very grim forecast from this business. They're going through a restructuring plan. They're having to spend heavily on new facilities and new factories. And at the same time, they see a steep drop in PC demand. And the forecast going forward is very disappointing for investors. Of course, you can see that reflected in that price. A very dire picture, at least in terms of the pre-market picture for Intel on that forecast. And again, slowing PC demand. Whether or not this cloud business can kick in to gear in the second half of the year is a key question for Intel. Right, let's get back to the US economy. Beating expectations in the last quarter of 2022, slowing slightly, but still expanding at a very healthy clip, 2.9% annualized rate. We are joined now by Annika Trion, Chief Economist at Van Lanschot Kempen. Annika, thank you for joining us this morning. I want to get your views then on the transparency we're getting, at least the clarity around the US economy. You lift the hood. The concern from Bloomberg Economics is that the consumer, that engine within the US economy, is starting to lose steam. Do you share that concern?
Well, absolutely. And, you know, you've got this constant dilemma, because on one hand, at the margin, again, look at the latest reported GDP, actually better versus expectations. On the other hand, watch the leading indicators. And like with many other developed countries, we're now 7 months in consistent declines in leading indicators. And your point about the consumer, we fully agree with that. What you're seeing is consumer expenditure, which has held up relatively well thus far, has been fueled by dis-saving, so eating up into savings, which is not sustainable.
What about the view then that at the top line you have GDP coming in slightly stronger than expected, you have a job market that remains relatively resilient, and the inflation has started to peak in the US, and therefore you are starting to see the outlines, at least, of this soft landing for the Fed? You push back on that narrative, do you?
Yeah, and I think that's exactly what's been fueling the markets thus far. So year to date, we've had a phenomenal start to the markets. And the reason for that is this talk of Fed pivots has gained a lot of fuel. So, you know, the market is anticipating rate cuts already in second half 2023. Year-end 2023, rate expectations of the market are below what the Fed themselves are putting out there. And, you know, that gap is the story of 2022. That gap is the story, actually, of 2023. We think it's far too early to already price in a Fed pivot, given stickiness around inflation and, more importantly, around credibility issues that central banks such as the Fed have to remedy.
What are the leading indicators here in Europe telling us about the prospects for this European economy, and whether indeed it can weather and survive and get through the year without a recession?
I mean, I think, again, part of the reason why markets have been so strong, especially the European outperformance year to date, it's been an amazing job to see how successful, you know, the developments of natural gas storage levels have been in Europe. It's been such a successful job. We're actually above the normal sort of level of storage corridor. And that's been very, very helpful in terms of European economy, European recession risks, because, you know, the major energy crisis we were all fearing, energy rationing, that seems further and further away from us. So that's very helpful for a European picture. Having said that, again, look at the weakness from a consumer perspective. You know, real wage declines are even more of an issue in Europe versus the US. And there are some other fundamental issues, and what doesn't help there is that the central bank in Europe, the ECB, is actually behind the curve versus the Fed. You know, it's still very strongly on its hiking path. And we haven't even started QT. We haven't even started quantitative tightening, which starts in March.
And the quantitative tightening element is something of an unknown as well, isn't it? There's a survey by Bloomberg of economists, and the majority now see the ECB hiking, to your point, to 50 basis point hikes coming through before pausing. Does the European economy, can it stomach a further 100 basis points of hikes?
Well, I think, you know, the energy crisis point is crucial, because had that gone out of control, had we not been so successful in those gas storage situations, it could have been a really gloomy outlook for Europe and a massive dilemma for the ECB to figure out how do you combat inflation without bringing a very hard landing. So I think that's a big relief. So that's why a lot of people are talking about a mild recession instead of a heavy recession in Europe. And, you know, we simply have to continue to track the data to see how things are progressing.
Okay, Annika Trion, Chief Economist at Van Lanschot Kempen. Thank you very much indeed for joining us this Friday. Have a great weekend. Thank you for the analysis. Coming up, the UK's Chancellor of the Exchequer is expected to outline plans to tackle sluggish growth. That's in a speech due to begin shortly here at Bloomberg's European headquarters. We're going to bring you more on that, of course. And we're going to be speaking with Jeremy Hunt afterwards on Bloomberg TV. Do not miss that conversation. 10:30 a.m. UK time. This is Bloomberg.
Coming out of World War II into the 1950s, you mentioned that the Fed had imposed yield curve control, basically to finance the wartime deficit. They were trying to move off of that. These are all sort of familiar themes to anyone in 2022, but why was that difficult for them?
Well, so let's get a sense of scale, right? So in 1941, there's about $40 billion worth of treasuries outstanding. In 1945, there's about $240 billion worth of treasuries outstanding. So that's about double the pre-war GDP. If you scale that to 2019 and say, okay, COVID expenditures on the scale of World War II, that's about $40 trillion. And the question is, who's going to buy it? Yeah. And
so what we're dealing with is kind of nothing. We got it.
In that context. And so that's where I guess the analogy breaks down. But it's a very difficult problem, which is who's going to buy the equivalent of $40 trillion today in debt?
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today.
Nobody covers business like Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Let's get to the Bloomberg First Word News now with Leanne Gerrans. Leanne.
Tom, good morning. Bloomberg has learned that Japan and the Netherlands are set to join the US in limiting China's access to advanced chip-making machinery. We're told that officials from the two countries will conclude talks on the details as soon as today. The joint effort will further undercut Beijing's ambitions to build its own domestic microchip capabilities. Now, the US economy beat expectations in the final quarter of 2022. GDP rose at an annualized pace of 2.9%, cooling from 3.2% in the third quarter. Some economists said there were warning signs in the data, especially in the weakening consumer demand, to suggest that a US recession remains a big risk this year. Now, shares in Adani Group companies are lower today, extending a sell-off that began after short seller Hindenburg Research published a report accusing the firms of fraud. After Indian markets were closed yesterday, Adani Enterprises lost as much as 6% in early trading in Mumbai this morning, with some group stocks down as much as 15%. Adani has firmly refuted the allegations, and Bloomberg understands the company plans to issue a further detailed response, which should come later today. Global news 24 hours a day on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Tom.
Leanne, thank you very much indeed. Right, coming up, the UK's Chancellor of the Exchequer is expected to outline plans to tackle sluggish growth in a speech due to begin shortly here at Bloomberg's European headquarters. We will bring you more on that, of course. And we're going to be sitting down speaking with Jeremy Hunt afterwards. That is with Anna Edwards on Bloomberg Television. Do not miss that conversation, 10:30 a.m. UK time. This is Bloomberg.
We have only 8% of the ocean protected today. And our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least, 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Welcome back. UK Chancellor Jeremy Hunt is set to outline his plans to boost the British economy in a speech shortly here at Bloomberg's European headquarters. Let's bring in Bloomberg's chief Europe economist, Jamie Rush, then, who has been, of course, always in the weeds on the UK economy as well as the broader European economy. Jamie, I want to start by stepping back a little bit and getting our viewers up to speed on just where the UK economy stands with the data that we've seen year to date. Is there a bit of resilience that we're starting to see now in the UK economy?
Well, I think it's right to say that the economy has held up better than most people expected in the face of the energy shock. And now, of course, things are changing very fast. Energy prices are about half what they were in December in wholesale markets. And this is a change in the outlook. It means that any recession is likely to be much more shallow than people previously anticipated, and therefore the economy is going to be a bit stronger.
Does it give the Chancellor a little bit more dry powder as well? Could we be looking at a Chancellor who is now in a position to start either ramping up spending or cutting taxes?
I think that's extremely unlikely. So what matters for the public finances is the long-term outlook for GDP growth. We heard earlier this week that the OBR is likely to downgrade its medium-term growth forecast, leaving less money to spend on services and less room to cut taxes. So I think, I've seen more black holes in the public finances than Stephen Hawking, I think, but this is just another one, and we're going to have to hear how he's responding to it. Unfortunately, it's unlikely he's going to be able to grow his way out of this problem.
What is the prescription then? It's clearly very, very challenging, as you allude to there. Are there obvious things that the Chancellor can reach for, at least, if not to accelerate and turbocharge this economy, at least reduce the damage to some extent? There are some obvious things that this Chancellor can reach for.
Well, if you look at one of the reasons why our economy has grown more slowly than our G7 peers, it's partly because business investment has been incredibly weak. There's like a 20% shortfall since Brexit relative to G7 average. What do companies not like? They don't like uncertainty. So I think what we really need to do is end the corrosive uncertainty about our position in Europe, and obviously the political situation hasn't helped either. So I think that's the first thing that they can actually do to lift investment, but the fruits of any growth plan are going to be born many years ahead, not in the next 5 years.
Okay, and we're seeing live pictures now of Grant Shapps here at the Bloomberg European headquarters ahead of the Chancellor of the Exchequer. Of course, he'll be taking the podium just in the next few minutes. When he talks, and exactly around the question of Brexit, we've had this preview that suggests he's going to be talking about the benefits of Brexit. I think you can objectively say that we haven't seen much evidence of the benefits of Brexit to this point. What do you think he's going to nod to around what Brexit allows us to do that could be a stimulus to this economy?
Well, I'm on tenterhooks.
Yeah.
I've got no idea how he's going to dress that up. I mean, we know what we can identify fairly clearly is the costs. We can see what's happened to investment. We can see what's happened to GDP relative to peers. We can see what's happened to productivity. For me, it seems pretty unlikely we're going to get a major change in those trends in the next year or two.
I mean, the car industry, that was a reminder this week as well, just the crushing blow to the auto industry, particularly since 2016, and guess what, that aligns with that Brexit vote. The manufacturing sector of the UK being hollowed out. Is there an acceptance, basically, here that manufacturing is not coming back to the UK, that we have to continue to focus on services, or is there an opportunity around manufacturing if there is the right policy prescription, the right plan put in place?
I mean, you're absolutely right to single out the automotive industry, and obviously there's been huge supply chain constraints as well. But it's much harder to do business in Europe and move things across borders. So it's hard to imagine the car industry is going to recover in a meaningful way. Long term, though, I don't think they're going to ditch manufacturing as part of the plan for growth. I think it's there's a global trend towards reshoring supply chains, towards being a bit more resilient domestically on the things that we produce. So I think he'll be headed that way, but the problem is you've got to throw some money at it, and there isn't any sign that's what they're going to do.
Okay, step back a little bit to the macro then, and you touched on the recession, and you think it's going to be a slightly milder recession. So you and the team still think there is going to be a recession here in the UK, but it'll be slightly milder. Is that correct?
That's right.
Okay.
So, I mean, but certainly we think growth stagnating in 4Q seems likely, and then the first couple of quarters in the year, as we see the persistence of that shock to real incomes really hitting household consumption. But mild recession.
Money market's pricing in a cut from the BOE by the end of this year. Is that realistic? Back down from 4.5% to 4.25% for the terminal rate by the end of this year?
I think it's I don't think it's plausible. I mean, I think it's more likely you don't get to 4.5%, and that they pause earlier and then stay on hold for longer. But of course, we'll be subject to global developments. If there's a recession in the US, we're not going to be immune to that. So if that breaks out in the second half of the year, that may be why people are starting to think that there'll be a cut here.
We were unpacking the GDP data out of the US earlier today, and part of that, and part of the concern from your colleagues stateside was the weakness that started to come through for the consumer. Are we seeing a similar story play out here in the UK?
I mean, the context is different because of the squeeze on incomes is obviously quite different. And, in the US, they've been compensated much better with higher wage growth. But, I would expect that we are going to see some weakness creeping in. We already see the labour market is starting to cool a little bit. Vacancies are tipping down. So we are at a hinge point for the UK economy. The question is, how quickly does
so that household balance sheet, that is a similarity with the US. Different components feeding into that, but there's always been a bit of a nod. Okay, households do have a bit of resilience in terms of the balance. Is that starting to erode? How much more space do households and families have to kind of tie themselves over?
Some households have it, right? Yes. So it's certainly true that buffer still exists, and households are beginning to dip into it, but only those who've been able to save, which is the upper quartiles of the income distribution during the pandemic. Those who don't have savings, I mean, this is just going to be catastrophic as it continues to be. So I think there's a clear split in the UK, and that's going to be manifest at a macro level, but you won't see it as substantially.
And you talked in some detail at the start of this conversation about the benefits of slowing, at least easing energy prices. Where does that leave your forecast for inflation here in the UK by year end?
So we're now expecting inflation to be down to about 3% by the end of the year, which is obviously a big turnaround from 10, 11% that we've seen recently.
Very big, yeah.
And it is led by that drop in energy costs. So there's good news there. It's just we need to get through this next couple of quarters and then see where we are.
Okay, tying that back then to your analysis around the BOE. Can the BOE live with 3%? It's not their target, but can they, if they don't nod to it officially, can they accept that maybe inflation around 3% is the new normal?
I think they'll be increasingly comfortable as inflation heads down to 3%. And for me, 3%, even 4% for next year would be a really great outcome. Like that would be good. Especially if it's led by wage growth. But for the bank, obviously, they're just going to keep talking about 2%. Now is not the time to revisit inflation targets, not when inflation expectations are so loosely anchored. So they're going to stick with 2%. They're going to talk a tough game, but privately, I would imagine they'd be fairly comfortable with inflation at 3%.
You are, of course, our chief European economist, so I want to get you to tie the European story to the UK then. And increasingly, the debate that maybe Europe manages to get through 2023 without hitting a recession, and of course, a big part of that, again, will be the energy story. Does that align with your view? And therefore, what is the impact to what extent does that provide a little bit of ballast, at least for the UK?
Yeah, it will. I mean, so we've revised up our Eurozone forecast. We've taken the recession out. So, it's been astonishing, the the warmer winter, there's 40% more gas in storage than on average over the past 5 years at this point. It bodes well for this winter and next winter, and that's why gas prices have fallen. That's going to be, well, for the Eurozone, it passes through more quickly to inflation as well for some countries. They do it differently relative to how we do it here in the UK. So, yes, the Eurozone's looking better. Some countries will benefit from the China reopening as well. And yeah, some of that benefit will pass through to the UK over the coming year.
It's obvious to point when you look across Europe at the beneficiaries of that China reopening, whether it's the auto space or chemicals or luxury, where does the benefit of a reopened China play out for the UK? Is it the tourism trade, or is there more to it than that? Is there a manufacturing boost that comes with that?
I wouldn't say it's a huge manufacturing boost, maybe a little bit. I mean, Germany is the country which will benefit the most among the EU countries. But really, I mean, who's going to benefit from China? It's Saudi, it's Australia, it's like the commodities exporters. They're the ones who really benefit from the China reopening. But we'll get some updraft.
Yeah. And when we talk about China, we think about semiconductors and the news today that there's going to be further restrictions, and then that ties us to the Bloomberg scoop about this government outlining some support for UK semiconductors. That an example of a hands-on approach, they would argue, long-term planning to shore up the resilience of the UK's latent tech genius and tech strength. Is that an example of what this government can do within all of the constrictions and limitations that you've outlined for us?
Yeah, I mean, one thing I'd say is, I mean, the UK is at the forefront of innovation. It's just the trouble is we don't tend to monetize it all that well. So there is space there to do something. But there's also a question of scale here. Like what they're doing in the US with the Inflation Reduction Act, which is basically green subsidies, what the EU might be cooking up over the coming 6 months, they're going to dwarf probably what the UK is likely to do, because we haven't heard anything about fresh cash for that. So I think we are at risk of being left behind on the green transition.
We're still at risk of being left behind on the green transition. Matt Clifford, by the way, Chief Executive and Co-founder of Entrepreneur First, is who you can see at the podium right now as we wait for the UK Chancellor, of course, to give that speech at Bloomberg's European headquarters. And just a reminder as well, Anna Edwards of Bloomberg TV, of course, will be sitting down and having a conversation with the UK Chancellor at around 10:30 a.m. UK time. So we'll take the speech, and then Anna will have that interview with the UK Chancellor. So really worth sticking around for both of those components. Let's bring back Jamie Rush then, and that comment on the UK being left behind in terms of the shift to renewables. And of course, we're all waking up, we're still adjusting to the enormity of the Inflation Reduction Act out of the US, and you see officials in Brussels scrambling for a European response. A response is needed from Whitehall.
I think it is, yeah. The Europeans, the EU is likely to do something reasonably substantial, I would think, because Europe has already made quite a lot of headway in green technology and attracting those businesses and developing those businesses. So it stands to lose a lot from the US attracting talent and business across the pond. So I mean, the UK really needs to form some sort of strategy around this, and unfortunately that means some money, some subsidies. Needs to be put in. Otherwise, we're going to be buying the technology that other people come up with, but not going to be producing it ourselves.
Are you surprised by the resilience of the pound, 123 on sterling, because it has a tie into the inflation input as well?
I'm not hugely surprised. I mean, I think that the main driver of the the exchange rate outlook has been monetary policy over the past year, with the exception of that moment in October, November, which I won't mention. So I think it just reflects that, a growing acceptance that the Bank of England is going to have to raise to rates that are close-ish to what the Fed's doing at 5% or so. So it reflects.
But it does offset. Does it offset some of the inflation input as well? Given we import so much.
Yeah, it does, but it's fairly second order compared to the major problems. If you think, like, what are the problems with inflation in the UK? Well, one of them is we've got wage growth at 7%. I mean, that's going to be driving up inflation in the medium term. The economy is obviously, as I said, looking more resilient. That's going to drive up risk to inflation in the medium term as well. So, I mean, the news recently is basically all going to be leading the Bank of England to be feeling more hawkish in the near term, at least. And that, of course, helps explain why the currency is is holding up.
Okay, you avoided it, but it was the moron premium of that mini budget, of course, of Liz Truss and the former UK Chancellor Kwasi Kwarteng, and some of that moron premium has come off, particularly within gilt. Just in terms of the prospects, again, the labour market tightness is a conversation we have when we reflect on the US, but also here in the what do you see? How does this UK labour market shape up towards the end of this year? You are forecasting recession. It's going to be shallow. What does the labour market look like at end of 2023? How much damage do you expect to see?
I mean, the shallowness of the recession kind of speaks to the point about the labour market. We think unemployment will rise a little bit over the coming quarters, like maybe half a percentage point. Will that be enough to take the heat out of wages?
Okay.
Not on its own.
Jamie, you've been an absolute star. I've been peppering you with questions. Let's cross over now to the UK Chancellor of the Exchequer, Jeremy Hunt, with that speech here.
Welcome.
At
Thank
Bloomberg.
you, Con, for having us. Thank you all for joining us at Bloomberg. From the way we communicate and collaborate to the way we buy and sell goods and services, digital technology has transformed nearly every aspect of our economic lives. How do I know that? Because I too, just like Matt, asked ChatGPT to craft the opening lines of this speech. And who needs politicians when you've got AI? Like other countries, the UK has been dealing with economic headwinds caused by a decade of black swan events, a financial crisis, a pandemic, and then an international energy crisis. And my party understands better than others the importance of low taxes in creating incentives and fostering the animal spirits that spur economic growth. But another conservative insight is that risk-taking by individuals and businesses can only happen when governments provide economic and financial stability. So the best tax cut right now is a cut in inflation. And the plan I set out in the autumn statement tackles that root cause of instability in the British economy. The Prime Minister talked about halving inflation as one of his 5 key priorities, and doing so is the only sustainable way to restore industrial harmony. But today I want to talk about his second priority, to grow the economy. And just in case you weren't completely sure of that, I've helpfully put it up on a screen behind me. We want to be one of the most prosperous countries in Europe. And today I'm going to outline the 4 pillars of our plan to get there. Just as our plan to halve inflation will require patience and discipline, so too will our plan for prosperity and growth. But it's also going to need something else which is in rather short supply, optimism that we can get there. Just this month, columnists from both left and right have talked about an existential crisis, Britain teetering on the edge, and that all we can hope for is that things don't get worse. I welcome the debate, but chancellors too are allowed their say. And I say simply this: declinism about Britain is just wrong. It's always been wrong in the past, and it's wrong today. Some of the gloom is based on statistics that don't reflect the whole picture. Like every G7 country, our growth was slower in the years after the financial crisis than before it. But since 2010, the UK has grown faster than France, Japan, and Italy, not at the bottom, but right in the middle of the pack. Since the Brexit referendum, we've grown at about the same rate as Germany. Yes, we've not returned to pre-pandemic employment or output levels, but an economy that contracted 20% in a pandemic still has nearly the lowest unemployment for half a century. And whilst our public sector continues to recover more slowly than we would like from the pandemic, strengthening the case for reform, our private sector has grown 7.5% in the last year. Yes, inflation has risen, but it's still lower than in 14 EU countries, with interest rates rising more slowly than in the US or Canada. And yes, we have to improve our productivity, but output per hour worked is now higher than pre-pandemic. And last week, a survey of business leaders by PwC said the UK was the third most attractive country for CEOs expanding their businesses. Economists and journalists know you can spend a long time arguing the toss on statistics. But the strongest grounds for optimism comes not from debating this or that way of analyzing data, but from what we've been hearing about this morning, our long-term prospects. Because when it comes to the innovation industries that will shape and define this century, the UK is powerfully positioned to play a leading role. Let's just look at some of them. In digital technology, as we heard from Michelle, we have become only the third economy in the world with a $1 trillion sector. We've created more unicorns than France and Germany combined, with 8 UK cities now home to 2 or more unicorns. The London-Oxford-Cambridge triangle has the largest number of tech businesses in the world outside San Francisco and New York. PwC say that UK GDP will be up to 10% higher in 2030 because of AI alone. FinTech attracted more funding last year than anywhere in the world outside the US. Or life sciences, where we also have the largest sector in Europe and a brilliant advocate with our superb science minister, George Freeman. We produced one of the world's first COVID vaccines, estimated to have saved more than 6 million lives worldwide. We identified the treatment most widely used to save lives in hospitals, saving more than 1 million lives across the globe. We're behind only the US and China in terms of high-quality life science papers published, and every one of the world's top 25 biopharmaceutical firms has operations in the UK. Another big growth area is our green and clean energy sector. The UK is a world leader here, with the largest offshore wind farm in the world. Last year, we were able to generate an incredible 40% of our electricity from renewables. And on one day, a rather windy December the 30th, we actually got 60% of our electricity from renewables, mainly wind. McKinsey estimate that the global market opportunity for UK green industries could be worth more than £1 trillion between now and 2030. And we're proceeding with a new plant at Sizewell C, led by our brilliant business secretary, who also spoke very wisely and surprisingly classically earlier on. And I could also talk about our creative industries, which employ over 2 million people, grew at twice the rate of the UK economy in the last decade, and have made the UK the world's largest exporter of unscripted TV formats, helped give us a top 3 spot in the Portland Soft Power Index. Or our advanced manufacturing sector, key to exports, where we produce around half the world's large civil aircraft wings and its biggest aero engines, as well as around half the world's Formula One Grand Prix cars. And the golden thread running through the industries where Britain does best is innovation. Amongst the world's largest economies, the Global Innovation Index ranks us 4th globally. Those innovation industries now account for around 1/4 of our output. They've been responsible for nearly all our productivity growth since 1997. And they're also the reason that all of you are here. In the audience, we've got leaders from Meta, Microsoft, Amazon, Apple, and Google, the world's largest tech companies, all with major operations in the UK. We've got Monzo and Revolut, shining examples from our world-beating fintech sector. We have founders and CEOs from some of our most exciting UK technology companies like Proximy and Matilon. You are vital for Britain's economic future, but Britain is vital for your future too. So I want to ask all of you to help our country achieve something that is both ambitious and strategic. I want to ask you to help turn the UK into the world's next Silicon Valley. What do I mean by that? If anyone is thinking of starting or investing in an innovation or technology-centered business, I want them to do it here. I want the world's tech entrepreneurs, life science innovators, and green tech companies to come to the UK because it offers the best possible place to make their visions happen. And if you do, we will put at your service not just British ingenuity, but British universities to fuel your innovation, Britain's financial sector to fund it, and a British government that will back you to the hilt. Our universities are ranked second globally for their quality and include 3 of the world's top 10. In order to support the groundbreaking work they do in so many new fields, the government has protected our £20 billion research budget, now at the highest level in history. And as you look for funding to expand, we offer one of the world's top 2 financial hubs and the world's largest net exporter of financial services. The capability of the City of London, combined with the research strengths of our universities, makes our aspiration to be a technology superpower not just ambitious, but achievable. And today I'm here to say the government is determined to make it happen. But like any business embracing new opportunities, we should also be straight about our weaknesses. Structural issues like poor productivity, skills gaps, low business investment, and the overconcentration of wealth in the southeast have led to uneven and lower growth. Real incomes haven't risen by as much as they could as a result. Confidence in the future, though, starts with honesty about the present. So we want to be one of the most prosperous countries in Europe, and today I want to set out our plan to address those issues. That plan, our plan for growth, is necessitated, energized, and made possible by Brexit. The desire to move to a high-wage, high-skill economy is one that's shared on all sides of that debate. And we need to make Brexit a catalyst for the bold choices that will take advantage of the nimbleness and flexibilities that it makes possible. So this is a plan for growth. It's not a series of measures or announcements, which will have to wait, I'm afraid, for budgets and autumn statements in the years ahead. But this plan is a framework against which individual policies will be assessed and taken forward. And I set out that plan, those priorities, under 4 pillars. They build on the people, capital, ideas themes set out by the Prime Minister last year in his May's lecture, and as such are the pillars essential for any modern innovation-led economy. For ease of memory, the 4 pillars all happen to start with the letter E, the 4 E's of economic growth and prosperity, and they are enterprise, education, employment, and everywhere. So let's start with the first E, which is enterprise. If we're to be Europe's most prosperous economy, we need to have, quite simply, its most dynamic and productive companies. Now, there's a wide range of literature citing the importance of entrepreneurship on business dynamism, whereby more productive firms enter and grow and less productive firms shrink. But I don't just believe the theory, I've put it into practice. I set up and ran my own business for 14 years. It was one of the best decisions I ever made, and I actually owe it to Margaret Thatcher and Nigel Lawson. Because by the time I got to university and was thinking about my career options, they had changed attitudes towards entrepreneurship. Had they not, I would probably have ended up in the city or the civil service. Instead, I took a different route to end up in the Treasury, less the fast stream, more the long way round. But like thousands of others setting up on their own, I learned to take calculated risks, to live with uncertainty, and to work through failures, of which there were many. Every big business was a startup once. And we won't build the world's next Silicon Valley unless we nurture battalions of dynamic new challenger businesses. Today, we are already ranked by the World Bank as one of the best places to do business amongst large European nations, second only to America in the G7. And the result of that pro-business climate is that since 2010, we've created more than 1 million new businesses in this country. But the question I want to ask is, how are we going to generate the next million? And firstly, we need lower taxes. In Britain, even after recent tax rises, we have one of the lowest levels of business tax as a proportion of GDP amongst major countries. But we should be explicit. High taxes directly affect the incentives which determine decisions by entrepreneurs, investors, or larger companies about whether to pursue their ambitions in Britain. With volatile markets and high inflation, sound money must come first. But our ambition should be to have nothing less than the most competitive tax regime of any major country. That means restraint on spending. In case anyone is in any doubt about who will actually deliver that restraint to make a low-tax economy possible, I gently point out that in the 3 weeks since Labour promised no big government chequebook, they've made £45 billion of unfunded spending commitments. But it isn't just about lower taxes. We also need a more positive attitude to risk-taking. Let's start with one of the most public risks taken this year. Richard Branson, his team, and the UK Space Agency deserve massive credit for getting Launcher One off the ground in Cornwall. The mission may not have succeeded this time, but what we learn from it will make future success more likely. We should heed the words of Thomas Edison, who said, "I haven't failed 10,000 times. I've successfully found 10,000 ways that will not work." Edison was American, and our attitude to risk in this country can still be too cautious compared to our US friends. But we are capable of smart risk-taking in this country. At the start of the pandemic, we bought over 350 million doses of vaccine without knowing if they would actually work. And we ended up with one of the fastest, most effective vaccine programs in the world. We also need, if we're going to deliver those competitive enterprises, smarter regulation. Brexit's an opportunity not just to change regulations, but also to work with our experienced, effective, and independent regulators to create an economic environment which is more innovation-friendly and more growth-focused. Our Chief Scientific Advisor, Sir Patrick Vallance, is currently reviewing how the UK can better regulate emerging technologies in high-growth sectors, and the government's identifying where to reform the laws we inherited from the EU. In the digital space, Sir Patrick is working with the brilliant Matt Clifford, who we heard from earlier, and our amazing Culture Secretary, Michelle Donnellan, both of whom gave excellent speeches. Before we conclude those findings, we want to hear from you, and that's why we've invited you this morning. And we'll repeat that process for green industries, life sciences, creative industries, and advanced manufacturing. Finally, when it comes to the E of enterprise, there is a critical need for easier access to capital, particularly scale-ups. I'm supporting important changes to the pensions regulatory charge cap. I've used the regulatory flexibility provided by Brexit to change the Solvency II regulations, which will begin to be implemented in the coming months. Alongside other measures announced in the Edinburgh reforms, this could unlock over £100 billion of additional investment into the UK's most productive growth industries. But there's much more to be done, and I want to harness the ideas and expertise in this room to turn the E of enterprise into an enterprise culture built on low taxes, reward for risk, access to capital, and smarter regulation. Now, the next E is education. And this is an area where we have made dramatic progress in recent years, thanks to the work of successive Conservative education ministers. The UK has risen nearly 10 places in the global school league tables for maths and reading since 2015 alone. Our teachers and lecturers are some of the very best in the world. As the Prime Minister said, having a good education system is the best economic, moral, and social policy any country can have. And that's why in the autumn statement, we gave schools an extra £2.3 billion of funding, and why the Prime Minister recently prioritised the teaching of maths until 18. But there is much to improve. We don't do nearly as well for the 50% of school leavers who don't go to university as we do for the ones who do. We have around 9 million adults with low basic literacy or numeracy skills, over 100,000 people leaving school every year unable to reach the required standard in English and maths. And that matters. We are becoming an adaptive economy in which people are likely to have to train for not one, but several jobs in their working lives. Not having basic skills in reading and maths makes that difficult, sometimes impossible. And equally important is what happens beyond school. We've made progress with T-levels, boot camps and apprenticeships, and Sir Michael Barber is advising the government on further improvements to the implementation of our reform agenda. And we want to ensure our young people have the skills that they would get in Switzerland or Singapore. If we want to reduce dependence on migration and become a high-skill economy, the E of education will be essential. And that means ensuring opportunity is as open to those who don't go to university as to those who do. So, Silicon Valley enterprises, Finnish and Singaporean education and skills. Let me now turn to the third E, which is employment. If companies can't employ the staff they need, they can't grow. High employment levels have long been a strength of our economic model. Since 2010, we have seen a record employment rate, the lowest unemployment in nearly 50 years, and labour market participation at an all-time high, partly thanks to the coalition reforms of a decade ago. We are at 76% employment levels, higher than Canada, the US, France, or Italy. But the pandemic has exposed weaknesses in our model. Total employment is nearly 300,000 people lower than pre-pandemic, with around 1/5 of working-age adults economically inactive. Excluding students, that amounts to 6.6 million people, an enormous and shocking waste of talent and potential. Of that 6.6 million people, around 1.4 million want to work, but a further 5 million don't. So it's time for a fundamental program of reforms to support people with long-term conditions or mental illness to overcome the barriers and prejudices that prevent them from working. We will never harness the full potential of our country unless we unlock it for each and every one of our citizens. Nor will we fix our productivity puzzle unless everyone who can participate does. So to those who retired early after the pandemic or haven't found the right role after furlough, I say Britain needs you, and we will look at the conditions necessary to make work worth your while. That's why employment is such a vital third E. Enterprise, education, employment. 3 key components for our long-term prosperity. And I conclude with my final E, everywhere. That means ensuring the benefits of economic development are felt not just in London and the South East, but across the whole of the UK. It is socially divisive if young people feel the only way to make a decent living is to head south. But it's also economically damaging. If our second cities were the productive powerhouses we see in other major countries, our GDP would be nearly 5% higher, making us second only to the United States and Germany for GDP per head. And that's why levelling up really matters, and why last week it was so exciting to see the progress being made. Since February 2020, when the levelling up agenda really got underway, 70% of new employed jobs have been created outside London and the South East. Thanks to our powerhouse regions, we remain one of the top 10 manufacturers globally, And the same is starting to happen with new industries, whether fintech in Bristol, gaming in Dundee, clean energy in Teesside. Every region has seen pay grow faster than London since 2010, which shows that our approach to regional growth is working. But there's much more to do. And whilst government grants can play a galvanizing role, they aren't the whole answer. We also need the connectivity that comes from better infrastructure. That's why in the autumn statement we protected key projects like HS2, East-West Rail and Core Northern Powerhouse Rail. Digital connectivity matters as well, which is why under Michelle's
the UK Chancellor Jeremy Hunt there outlining his growth plans for the British economy in his speech here at Bloomberg's European headquarters in London. You can, of course, continue watching it on Live Go. A couple of key lines that jumped out of this speech then. The UK Chancellor saying that the best tax cut right now is a cut in inflation, saying that the plan for growth will require patience and discipline, and repeating that he wants the UK to become the next Silicon Valley, saying he was outlining a framework for policies going forward. Jamie Rush, our chief European economist, is still with us. Jamie, your key takeaways, your key response, your reaction to this?
Well, I mean, I share the Chancellor's enthusiasm about the capacity for the UK to be at the forefront of innovation. That's certainly true, and there are some laudable aims there. But I think what was missing from the speech was that all the other businesses which are being left behind on the productivity side. We have a big, long tail of low productivity businesses, and if you really want to lift living standards for everybody, you need to target that tail of the distribution. Other thing that struck me was just the open goal that is halving inflation. You know, with energy costs where they are, you could put a suckling pig in charge of the country and it'd still halve by September. So I think, you know, they set themselves up for success as they measure it there.
Yeah.
But yeah, I mean, there's
okay. That's a wonderful image, Jamie. Thank you for your analysis as well, of course, on the back of that speech from the UK Chancellor. And of course, we are going to have a lot more from the UK Chancellor, Jeremy Hunt. We are going to be speaking. Anna Edwards will be speaking to the Chancellor on Bloomberg TV. That conversation at 10:30 a.m. UK time. Do tune in for that. The pound, by the way, is weaker, currently at 123, down 0.3%. The FTSE 100 trading up by 0.2%. Futures in the US lower by 0.3 on the S&P E-minis. Stay with us. This is Bloomberg.
Is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40-year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
When we look at what's happening with the consumer, which is the backbone of the U.S. economy, we are seeing a clear loss of momentum.
We are yet to see the earnings recession that is supposed to bring us into a recession. And this is simply because of inflation.
You've got to get to a point where inflation doesn't keep rearing its head.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Intel comes out with one of its gloomiest forecasts ever. The chipmaker has been hammered by a slump in the personal computer business. The sell-off in the Adani empire has now erased more than $50 billion in value. Asia's richest man is struggling to contain the fallout from a scathing report by a U.S. short seller. And the UK Chancellor, Jeremy Hunt, pushes back against the gloom over the UK economy. Bloomberg has an interview with Jeremy Hunt coming up this hour. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lines will be hosting the US Market Close show today. So, Matt, I'm going to be speaking to Jeremy Hunt a little bit later on this hour. He's busy setting out his plans, his vision for the UK economy. So that's going to be a big feature of our program.
Yeah, I saw his speech, and things look fantastic from his point of view for the UK economy. So I'm interested to see what he has to say when you interview him in just about 20 minutes' time from now. In terms of what's going on in markets, we know that China is still shut. So let's take a look at the rest of Asia, because there is some movement there, notably in the Sensex. You talk about the Adani story, and we're going to talk about that a little bit later, but it is weighing on Indian stocks right now. The Sensex down about 1.5%. It's off its session lows, but still a significant drop here. We see the Nikkei unchanged at the close in Japan, and the dollar a little bit weaker against the yen right now at 129.87, so just below the 130 mark there. Take a look at what's going on in terms of U.S. futures after the big rally that we had in the cash trade yesterday. Gains of more than 1% on the Dow, the S&P 500, and the NASDAQ. S&P futures now down about 1/3% to kick off the final trading day of the week. U.S. 10-year yields also rising a little bit, almost 5 basis points now, up to 354. So finally a little bit of movement in that number. Also movement in crude. It had been stuck around $80. Now it's up at 82.06, a gain of about 1.3%. And Bitcoin holding steady at just about 23,000, so $22,952 a piece. What do you see in terms of the European moves?
Yeah, well, we've actually managed to shrug off a little bit of the early weakness that we did see on European stocks, Matt. So we opened pretty negatively, at least in the first half hour of trade, and regaining a little bit of that. Of course, we're dealing with the earnings story right in the midst of the earnings deluge for European corporates, and that's weighing in here as well. The FTSE 100 up at 1/8% or so, as is the CAC 40. The DAX is fairly flat. Energy is one sector that is in focus today. Energy stocks actually moving higher, and Brent crude is partly the reason for that, up by 1.3%, slowly making those moves higher. higher. 88.57 is where we trade on the price of a barrel of Brent crude right now. These are some really interesting stories that we have for you right now. H&M is in focus, down by 6% in today's session. And actually, the retail sector under pressure as a result of the numbers out of H&M. Surging costs is part of the story here. So because they make a lot of their clothes over in Asia, the shipping costs got so high that bringing those into other markets globally has proven to be an expensive business. And so they're looking for sources of material, sources of product that are a little nearer to home. Sainsbury, also worth a mention, up by 4.5%. This is the grocery business here in the UK, and that stock is on the rise. We've heard from one of the other operators, a convenience store operator called Bestway. They're buying 3.45% of Sainsbury's. No plan to make an offer for the business as yet, but certainly that's put some M&A speculation and fire under the stock this morning.
We will keep our eye, of course, on UK grocers, but really the big story for markets is chips. Intel shares falling today. The chip maker gave one of the gloomiest forecasts in its history after a personal computer slump hammered its business. CEO Pat Gelsinger spoke after the company released its results.
I want to remind everyone that we are on a multi-year journey. We remain focused on the things that are within our control as we navigate short-term headwinds while executing to our long-term strategy.
Bloomberg Quick Takes Alex Webb joins us now to talk about what's driving the incredible declines. Really, Alex, if they hit the low end of their sales forecast, it'll be the worst quarter for sales since 2010.
Yeah, the market had been expecting a March quarter with sales in the order of 14.5 billion. Intel forecast between 10.5 and 11.5 billion. Massive, massive miss on that. And it's really to do with demand for personal computers, that we saw quite a lot of purchasing of electronics during the lockdowns. People needed them as they worked from home. Some people had a bit more disposable income. That front-loaded a lot of demand for electronics. Now there's a lot of inventory build-up amongst customers, i.e. the companies that make these laptops, desktops, and so on. Intel is really feeling that pain. It has been hemorrhaging share to the likes of TSMC in recent years, and it's going to take some time before they are able to compete again.
Okay, so that's the story out of Intel. Sticking with the chip story then, Alex, we've heard that the US is persuading the Netherlands and Japan to make a move. It's poised to join US efforts to keep China away from some of the most advanced technology on chips. Why is this significant?
Yeah, I mean, it is a massive deal. It's quite hard to underplay how significant this is. We've seen the US in recent years really crack down on the supply of high-end chips themselves to China, to the likes of Huawei, preventing them from getting them into their devices. That then reinvigorated Chinese efforts to come up with their own technology. So what the US is now doing is make it hard to sell the equipment that can make the chips. And it's not just the next generation equipment, which is called extreme ultraviolet lithography, makes sort of 3 to 7 nanometer circuits on semiconductors, but also the last generation. So it really throttles China's ability to make the chips they need to drive things like AI applications.
Alex, thanks very much. Alex Webb joining us there from Bloomberg Quick Take. Now, shares of Adani Group companies are continuing to tumble after the short seller Hindenburg Research published a report accusing the firms of fraud. The losses accelerated even after Adani disputed the allegations in a call with bondholders. Bloomberg's PR Sanjay joins us now from Mumbai. So Adani continues to push back against this narrative from Hindenburg. PR Sanjay, what is the latest in Adani's fight back? It's failing to persuade investors right now, but we are hearing from and expect to hear more from the Adani Group.
So Adani Group has, on Wednesday itself, they've issued a rebuttal. The CFO has come on television, they have circulated a video and issued a statement. And yesterday, it was a market holiday for India. The legal head also issued a statement threatening Hindenburg Research that they will go for legal solutions under Indian law as well as US law. But we are expecting a point-to-point rebuttal, a more detailed one from Adani Group. Indeed, yesterday, Adani had issued an 18-page rebuttal to bondholders and investors, but we are expecting a detailed one which can save some bit of follow-on offer, which is seeking to raise $2.5 billion from the market, which is started on 25th of January, and today they will reach out to retail investors, which will end on 31st January.
Okay, thanks very much, PR Sanjay. We'll leave the conversation there. The line a little bit different by on this story as it develops. Now, the UK Chancellor Jeremy Hunt has been speaking in this very building this morning, outlining his plans for growth and pushing back against calls for tax cuts. Joining us now is Bloomberg's chief Europe economist, Jamie Rush. And Jamie, he is still speaking, I think, and still talking about what he sees as the opportunities for the UK economy right now. What has stood out for you, having a few moments to digest some of the themes he's been talking about?
So I think one of the things is that, I completely share his enthusiasm about the capacity for the UK to be at the forefront of innovation. Well, that's certainly true. Historically, we haven't monetized it that well, and so efforts in that space are important. But what was missing from the speech was an acknowledgement that there's a huge tail of low productivity firms which aren't benefiting. And we really need to bring those businesses along with us across the country.
And productivity has been an issue for decades. We've talked about it a lot.
Yeah.
I mean, are there any new answers?
I think that's part of it, is that it's not just focusing on startups and scaling, it's also just bringing up all the other companies too. So there's something missing there. The other thing that struck me was that, we've had the Inflation Reduction Act in the US, which is a huge green package of green subsidies. I got no sense from the speech that anything's being cooked up in the UK, which means, of course, we're at risk of being left behind. So that's a worry.
Thus far, it looks to outsiders, I have to say, Jamie, like Brexit has been damaging, as if you've really shot yourselves in the foot. However, Hunt says it's an opportunity, and he can make it an incredible success. What's he basing that on?
So I think, Brexit has afforded some flexibility on adjusting some of the regulatory environment in the UK, so I imagine he's appealing to that logic. I think when you look at the facts, though, the UK economy is about 4% smaller since 2016 than our G7 peers. Like, we just haven't caught up on growth, and a lot of that is just because business investment has been incredibly weak. The UK is not, with the uncertainty we've seen and the lack of market access, it's just not as an attractive place to invest.
All right, we're going to continue to hear more from Jeremy Hunt. As Anna said, he's still speaking. Right now he's talking about some concerns that the UK has about the US Inflation Reduction Act. Those concerns are shared by his European peers, so it'll be interesting to see what he has to say about that in just a moment. Anna sits down for an interview with the UK Chancellor of the Exchequer in just about 15 minutes' time. Now let's take a look at some of the stocks we're watching in the pre-market today. Intel is one of the big ones. I mention it again because it's such a huge mover in regards to the entire sector. It's bringing down chip equipment provider KLA, as well as Advanced Micro Devices and Nvidia and Micron and AMAT, and every chip maker that you look at in the U.S. pre-market is trading down in sympathy with Intel after it gave an incredibly dour forecast for the current quarter, missing analyst estimates and bringing sales possibly back down to a level we haven't seen in over a decade. Now, BuzzFeed is extending its rally after a report that that company would rely on ChatGPT creator OpenAI to help create some of its content. So moving, I guess, away from journalists and towards artificial intelligence. And then Bed Bath & Beyond is edging ever closer to a bankruptcy filing after receiving a default notice from its loan agent. We see the stock actually up in the pre-market, but it's only trading at $2.50 a share. Anna?
Yeah, ChatGPT certainly everywhere right now. Two of the speakers at this morning's Treasury event deciding to start their speech with lines that were provided to them from ChatGPT. It is a sign of the times in 2023. Coming up on this program, Hans Olsen joins us, Chief Investments Officer at Fiduciary Trust. That'll be a conversation around the broader markets looking ahead to the year. And we'll get back to Intel's disappointing earnings with William DeGale, Lead Portfolio Manager for Technology at Blue Box Asset Management. What does he make of the assessment of this quarter? That seems to be in particular what's weighing on the business. A long-term story, says the company. Now, don't miss our interview with the UK Chancellor of the Exchequer, Jeremy Hunt, coming up later this hour. This is Bloomberg.
I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of the plus and not the must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
Season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number.
Blowing through estimates.
These guys are minting money with exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
Does this quickly become just a really crappy business model?
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Kayleigh Lyons will be hosting the U.S. Market Close show later on today. Now let's get to the Bloomberg Markets reporter Valerie Teitel. Valerie, you're looking at the recent Treasury auctions, and January apparently one of the best months ever for auction demand. Why are Treasuries so hot right now?
Yeah, one of the best months we've ever seen for the Treasury auction market. Now, I think this really reflects the sentiment out there with investors that these yields might not be around for much longer. We had a slew of Treasury auctions this week and all month that all sold below the prevailing market yield at that time, reflecting that just a heavy demand. Even the indirect bidding made some all-time records, broke a few all-time records in that regards. Now, all of this is kind of reflecting that, yes, we are predicting the turn of the U.S. business cycle and perhaps with it, the turn of the Fed. There's been a lot of dovish trades that have gone on in the front end. I want to take you through a few of them. They've been quite chunky this week, positioning for things like a 20 basis point rally next week. We have the Fed meeting as well as the payroll report, positioning for a Fed pause in March, positioning for 200 basis points of cuts out until December, and a very, very chunky yield curve steepener went through this week. That's again positioning for a possible Fed cut past neutral, leading that inversion of the curve to flip very, very quickly into steepening territory.
All right, Valerie, thanks very much for that. Valerie Teitel talking to us about Treasuries. Joining us to talk further is Hans Olsen, Chief Investment Officer at Fiduciary Trust. Hans, what do you think about the shift in sentiment we've seen and the slowdown we're now expecting from the Fed?
I think it's wishful thinking, Matt. At this juncture, it's hard to see why the Fed should back away from its program of normalizing interest rates, number one, and inflation is not completely out of the economy. I think, we're going to see later this morning the core PCE deflator, which is supposed to come in on a month-over-month basis of 0%. Based on what we saw in the economy yesterday with the fourth quarter GDP being stronger than expected, I'm not so sure, but we shouldn't be surprised if that number comes in, that deflator number comes in higher than expected, which would kind of ruin the setup for that trade.
Yes, it would ruin what a lot of people are thinking about. And maybe a lot of people's thoughts about the economy, Hans, were ruined yesterday by that claims number. Robust labor market in the United States, once again in evidence, despite everything that the Fed has thrown at the U.S. economy. Given that data backdrop, as we head towards the Fed, what is your assumption for how long rates stay as high as they are? I mean, high by recent standards, at least.
Yeah, high by recent standards, but ultimately the question is, where do they settle in? What's the relationship between the price of money and the price of things, right? Or the real rate of money? And we're still probably nowhere near, well, not probably, we certainly are nowhere near where it needs to be at the moment. I think they're going to stay with the program until the job is done, and the job is not done, which means that we could see the central bank holding the line on rates through the end of the year. So I'm not expecting any of this pivot or sort of Goldilocks scenario that you see playing out in the bond market right now.
Okay, so no pivot, no Goldilocks, but you do see opportunities in stocks then, but under new leadership, so not thanks to the tech sector.
That's right. We're seeing a rotation in leadership from these favored stocks of the last 4 or 5 years to more of the average stock. And one of the things that really stands out is if you compare the performance of the equal-weighted S&P 500 to the market cap weighted, that's pretty notable, the difference between the two. And I think we'll see more of that, which leads you to sort of what is old is new again, sort of the more mature companies with better profits or more higher quality balance sheet, more value orientation indeed. But you'll see it in the industrial sector, you'll see it in the energy sector, materials and the like.
Will we start to see more job cuts from those companies? We saw them from 3M a couple of days ago. We're seeing job cuts at IBM. Do you expect to see job cuts seep into the older economy?
I do, Matt, somewhat. I think we saw the hiring boom of the last several years perhaps was overdone. So people are cutting back from overstaffing levels, which could be the bit that forces the economy into recession. But I do think when you look at the number of jobs that are being put up every month right now relative to the layoffs, we're still putting on about 4 times as many jobs as there are announced layoffs on a monthly basis. So, the labor market's still in pretty fine fettle.
Looks tight, maybe not strong. What do you think about the depth of the recession or the length of the recession that you expect, Hans? I mean, we've seen, for example, a huge buildup in inventories, which a lot of economists told us yesterday are going to lead to even slower growth than we anticipated.
Yeah. So, I think the probability of recession, certainly the bond market is screaming it in terms of what the yield curve suggests, although the credit market's perhaps less so. I was looking at high yield spreads, the OAS there, and that doesn't suggest any sort of dislocation. If we have a recession, my expectation that it would be probably much more mild than people are used to, right? So if our reference point is the last recession for the pandemic or the recession before that, I think this is going to be something much smaller and perhaps even shorter.
So if someone comes to you with a significant amount of cash right now, what do? Do you wait? Is there a point at which you invest? Do you dollar cost average in?
Yeah, there is some foot dragging right now, right? Because the run that we've seen in the market, I think, is a counter trend rally. So it's a bull market rally in short. So I think there's a very good possibility that we're going to retest the lows that we saw last year. We possibly could punch through those lows down into 3,200, 3,300. None of that would surprise me at all. So we're building out European exposures first right now. We'll be going after those average stocks in the U.S. Start to layer that in. We're keeping duration short. And we're playing an optimistic but a defensive posture at the moment. And we still are carrying above average levels of cash.
And then in terms of fixed income, you mentioned high yield isn't screaming, credit isn't screaming recession right now. Are there pockets there that you like as well?
Yeah, not yet. It's simply the transaction's not fair, right, for the investor. I think the yield spreads are up, 460? They're about 460 basis points over. For me to get terribly interested in high yield or something like that, we'd have to see those up 600, 700, 800 in order for us to be inclined to take a hard look or indeed commit capital to that.
Hans, let me finally ask you about China, because the reopening there has spurred some to forecast a huge jump in commodities prices. Others say it's going to be offset by what we see in the U.S. and Europe. What's your view of the China reopening?
Oh, I think it's real and it's going to happen. It'll probably be bumpy, as we've seen with when Xi lifted the COVID restrictions. You know, COVID tore through the country. That's probably not over. Winter's not over. But I think that that's real, and that's why we've gotten more constructive on Europe, especially countries like Germany that are much more tied to you know, the Chinese economy. So I think that's real. That's going to play out over the course of the year, and that will be a catalyst for higher resource prices, higher energy prices, for sure.
Hans, it's always great to get some time with you. Thank you so much for waking up early for us this morning. Hans Olsen there is the Chief Investment Officer of Fiduciary Trust. Now let's keep you up to date with news from around the world. Here's the first word. Bloomberg has learned that Vladimir Putin is planning a new offensive in Ukraine. The Russian president also is preparing his country for a conflict with the U.S. and its allies that he expects to last for years. The Kremlin wants to show its forces can regain the initiative after months of losing ground. It's hoping to force Ukraine and its backers to agree to some kind of truce. The International Monetary Fund is considering an aid package for Ukraine worth as much as $16 billion. Bloomberg's learned that there are still a number of conditions, including endorsement from the Group of 7 nations. Ukraine's government also would need to commit to a series of policies in order to get that money. And a new survey of economists says that the European Central Bank, the ECB, will go for 2 interest rate hikes of 50 basis points each on its way to a May peak in rates. Then, according to the survey, the deposit rate will be held at 3.25% for about 1 year. Economists expect a struggling economy will eventually lead the ECB to cut rates, a pivot for Europe. Bloomberg has learned that House Republicans are considering a short-term extension of the federal debt ceiling until September 30th. That would give it more time to resolve an impasse with Democrats, but it's not clear if the Democratic-controlled Senate would agree. For now, accounting maneuvers could avert reaching the limit until July or even later. Well, if you listen to Joe Weisenthal with the $1 trillion coin, it could be a long time. Goldman Sachs warns that the next sanctions on Russian oil are likely to be more disruptive. The new penalties take effect next month. Among other things, they'll impact diesel fuel. Russian diesel exports accounts for 15% of total global flows. Now, coming up next, Anna Edwards speaks with the UK Chancellor of the Exchequer, Jeremy Hunt, from Bloomberg's European headquarters in London. This is Bloomberg.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Intel comes out with one of its gloomiest forecasts of all time. The chip maker has been hammered by a slump in the personal computer business. And the sell-off in the Adani empire has now erased more than $50 billion in value. Asia's richest man is struggling to contain the fallout from a scathing report by a U.S. short seller. And Jeremy Hunt, the UK Chancellor of the Exchequer, pushes back against the gloom over the UK economy. Bloomberg has an interview with Hunt in just moments from now. Anna Edwards sitting down with Jeremy Hunt. Let's get a check first on what's going on in the markets globally. We see futures here in the U.S. down as Intel really sours sentiment for chip makers. The rally that we've seen in Intel, it's up, I think, 13% year to date, could be completely erased by today's drop, and then you're seeing a number of other chip makers drop with it, or anybody connected to chips, from NVIDIA to Applied Materials to AMD to Micron, etc. The U.S. 10-year yield rising a little bit more than 4 basis points, 420 just briefly, so that was fun. 353.67 is the level we're looking at, going out 5 significant digits. And then Brent crude, as well as the entire crude complex, putting up some gains today, a little more than 1%. 88.44 a barrel, and we're seeing NYMEX West Texas Intermediate trade over $82 a barrel, so some real movement to the upside for the commodities. Finally, stocks in Europe were down earlier today, are now rising just a bit, 0.04% on the Stocks Europe 600 index. So some gains there, not beaten down as much by the chip sector, which is more prevalent in U.S. indexes. Speaking of those chips, Intel predicting a surprise loss in this current quarter, also saying that sales could be the worst since 2010. The shares falling 9% in the pre-market. We'll continue to give you the latest on Intel as we get closer and closer to the cash trade this morning. BuzzFeed gaining 20%, saying it's going to have ChatGPT help to write some of its content, and that is, I guess, the touchword of the day for markets. It's the new blockchain, ChatGPT. So BuzzFeed trading up to 252, and then Bed Bath & Beyond gaining another 1%, but of course it's only at 255 itself, edging closer and closer to a bankruptcy filing after receiving a default notice from its loan agent. Now let's get back, though, to our main story for the hour. UK Chancellor Jeremy Hunt joins Anna Edwards for an interview in just moments after outlining his plans for growth earlier in a keynote speech. Bloomberg's chief Europe economist Jamie Rush joins us now to talk about what to expect from the interview. Jamie, what did we hear in the Chancellor's speech just moments ago at our European headquarters in London?
Well, I think we've heard a lot about the framework that the government is using as it sets out policy to deliver stronger growth. What we haven't heard yet is much specific on the policies that are coming down the line. We're probably going to have to wait till March for that. A couple of things I would like to hear more about are what is the government going to do for the long tail of low productivity firms in this country? How are they going to raise productivity in that crucial element of the economy? And also just a bit more on the Inflation Reduction Act and the UK's response to it. We know that in the US there's a huge package of green subsidies that's going to suck investment across the pond. I wouldn't know how the EU is probably cooking something up. It'd be great to know what the UK is thinking about this.
Does the UK, Jamie, join with Europe in such measures? I mean, post-Brexit, is that still going to be something, the kind of thing they can do together?
I would say probably not. I think there's nothing that's going to be solved on the European side. I think until we have the Northern Ireland Protocol fixed. So I think that there's a big roadblock there for cooperation with Europe, and until that's unblocked, there's not going to be cooperation of the level that we would like to see.
Nonetheless, the Chancellor seemed really very upbeat about Brexit. How has the UK economy fared in relation to, say, European peers since the vote and since the move?
Well, I mean, I think since 2Q16, the UK economy has had a growth shortfall relative to G7 peers of about 4%. So really quite a material difference in the growth performance there. And when you look at some of the reasons behind that, business investment is massively lower than it has been elsewhere, like a 20% shortfall in growth in that area of the economy. Partly uncertainty around Brexit. If we can lift that, then maybe that's one route through to faster growth.
One of the platforms, the Bojo platforms, I always found very interesting was the idea of leveling up. And I wonder how that has fared thus far. How are other areas, regions in England and the UK doing compared to, I guess, the home counties when it comes to economic growth?
I mean, I think the progress on levelling up has actually been extremely limited. We haven't seen any convergence really of incomes or of prospects. And this is a multi-year, probably multi-decade problem that needs to be addressed, and we're not going to see fast results, unfortunately. But from what I've seen at the moment, the levelling up agenda hasn't quite delivered even the policies, I think, which would be required to move the needle at all.
Well, I heard an amazing fact on Bloomberg Radio this morning. 1/4 of UK home sales in the fourth quarter were done without a real estate agent because the prices have taken such a hit. Nobody wants to lose any more money on fees. How is the real estate situation in the UK right now, and has the Chancellor addressed it? Has the government looked at this situation?
I mean, I think there's probably quite a bit more bad news to come on UK housing. I mean, if you look at assets globally, they've all repriced to the higher long-term interest rate environment, right? That's not something we've seen with residential property yet. So the question really is, if this revaluation occurs, is it going to happen very fast? Are we going to see outright drops in prices? Or is it just going to be a period of slow growth in prices? And for me, I would guess that the house prices are probably going to drop quite substantially in the UK, simply responding to this huge increase in mortgage costs that is not UK specific, but is being faced by people across Europe.
For all the bad news in the UK economy, Jamie, the pound has really recovered quite well since it's dropped to parity. What's your outlook for the currency, and what are the big effects that play into it?
So I think, generally speaking, we think of the divergent monetary policy outlooks as being the main driver of short-term moves in the currency, except, of course, around the period of the mini-budget in the UK, which saw a disastrously high premium placed on the risk premium on UK assets. That has now eroded, as far as we can see. And so what's determining the outlook really is what the Bank of England is going to do relative to what the Fed is going to do. And where we've heard that the Fed is probably perhaps becoming a little bit more dovish, or at least that's the market perception, the Bank of England can't really afford to be yet, because wage growth is still running at about 7%, well above what's consistent with the inflation target being met in the medium term. And so, we're looking for a 50 basis point hike next week when the Bank of England meets.
From the outside, I'd say, Jamie, it just looks so grim in the UK. I imagine, trains not running because of strikes, wait times at the NHS going weeks long, inflation for, your average pint, like 10%. And I wonder what the actual consumer sentiment is like within the UK. How do consumers feel about the economy right now?
The economy, we have problems. As you just listed, we have some serious problems. But the economy has actually been surprisingly resilient to the energy crisis this year. The activity hasn't fallen off a cliff. We're not expecting a big contraction in the fourth quarter. There's probably something coming over the next couple of quarters, but again, probably likely to be quite a shallow recession if there is one. So actually, I'd say one thing that has happened over the past month, which is buoying everyone's mood, is that there's just this profound drop in energy prices in wholesale markets. We've seen across Europe a warmer winter. We've seen households be pretty frugal. We've also seen industrial gas use just fall off a cliff without hitting production. And so all these things have driven the price of gas down, driven down the price of electricity, and that's going to support the economy over 2023. And most people are revising up their forecast, both for the Eurozone and for the UK.
Finally, Jamie, could you just explain to those of us who are not following the day-to-day moves on the Northern Ireland Protocol, how does the government expect to solve this issue without putting a border in the sea and without putting a border to divide Ireland?
And I think the solution is going to require some flexibility on both sides. I think that's the challenge. And occasionally we get news that the negotiations seem to be progressing. Maybe at some point in the first half of this year we'll see something. But I mean, the key point though is that until that problem is resolved, it's just a huge roadblock for cooperation with the rest of Europe. And there's a lot of things which are important initiatives that really do need to be thought about collectively. And we're not at the table.
Like the IRA. Jamie, thanks so much for your time. Really appreciate you sticking with us today. Bloomberg's chief Europe economist, Jamie Rush. Now let's get over to Anna Edwards. She sits down with UK Chancellor of the Exchequer, Jeremy Hunt. Anna?
Matt, thank you very much. Yes, I'm very pleased to be speaking to the UK Chancellor of the Exchequer, Jeremy Hunt, who joins me here in the Bloomberg offices here in London. Very good to see you, Chancellor. Thank you so much for joining us. You've played down our expectations for tax cuts in the budget that is coming, but you've talked a lot about wanting to incentivise investment to get the economy growing. So let me start on investment. The corporate tax rate is going to go up by 6 percentage points in April. At the time that was announced, there was a lot of talk about specific reliefs that could be introduced to sort of soften the blow there. Is that something that you're going to be leaning on to try and encourage investment in the UK?
Well, at the moment, we don't have the headroom for major tax cuts, but if I was going to prioritise where I would like to see tax cuts, it would be business tax cuts that give us, as I said in the speech, even more competitive tax rates. It's important to say, Anna, we have the second lowest business taxes as a proportion of GDP amongst major countries. So the UK is already very competitive, but we want to do better. And we recognise that taxes are part of the incentive structure that companies react to when they decide where to invest. And my message this morning is very simple. If I was choosing where to invest out of all the different places you can go in the world, when you look at Britain's strengths in green industries, in creative industries, in life sciences, in technology, I would choose Britain.
Okay, so you want to incentivise investment in Britain. The truth, though, in recent years is that investment has been lagging behind the G7 average, and not just the G7 average, but all members of the G7. So what can you do to try and close that gap? You've ruled out big tax cuts, so what are the levers that you would look to be pulling?
Well, I talked about the 4 pillars of my plan to improve our productivity. And if we deliver on that, if we become the most productive as well as the most entrepreneurial country in Europe, I think we're already the most entrepreneurial, but this would make us the most productive, then I think that will make a very compelling case for investment. And that's why I outlined the plan. I think we've got a very exciting vision. I think we have the opportunity with our universities, our financial services, and our technology strengths to be a Silicon Valley. And I think that if I can make that happen, then I think this is the place people are going to want to invest.
That's what you want to encourage, to make a new Silicon Valley here. So are you looking at specific tax reliefs? Because, of course, the super deduction runs out. These are the kind of things that businesses want to look ahead to. Can they hope for that in March?
I think, as I say, it is unlikely we will have the headroom to do that. What businesses want, they do want to cut business taxes. Who wouldn't? I wanted that when I was running my own business. But what businesses want even more than lower taxes is stability. And inflation is a fundamental thread of instability in the economy. It's a worry for households. It stops them spending, and it puts off businesses from investing. So the first thing we have to do is the Prime Minister's plan to halve inflation. That is going to require patience and discipline. When we are able to, no one wants to cut taxes more than I do, but we have to recognize this is the priority for business as well as consumers right now.
It is one of the priorities that you've listed as a government. The US obviously worried about inflation there. They brought in their Inflation Reduction Act. Big subsidies in some shape or form for various industries there. You've said this morning that some elements of that policy worry you. Your colleague Grant Shapps described the policy as dangerous. What is it that worries the UK government about this policy?
Well, we think that if we're going to have the transition to net zero, we should benefit from free and open trade between all the countries that share that ambition, because that will mean we'll get there more quickly, more cost effectively than if we go it alone. So we do have concerns, but we're also very optimistic that the UK will play a leading role in that clean energy transformation. We get 40% of our electricity from renewables. We are second largest in Europe, the largest when it comes to offshore wind.
Will we do our own subsidies, though?
Well, we will announce our plans. I have absolutely no doubt that we will be able to present a package that makes us highly competitive. But I don't think subsidy is necessarily the best way. I think what people want is creativity, innovation, ideas, a climate, a regulatory structure that encourages investment. And if you just look, Anna, at the transformation that we've had in the last 10 years since we started moving away from carbon to renewables, we've done it without those huge subsidies. The US has got a bit of catch up to do because they had an administration that was very skeptical on climate change. I think there's a way that the UK can do very well.
Is there not a danger, though, that we get squeezed in the middle of some kind of subsidy war? If the Americans throw $400 billion at this, if the Europeans are thinking about throwing 300 billion euros at this, how does the UK on its own stand up?
Well, I think it's the wrong way to look at Britain right now to say we're so small and other places are so big. Because when it comes to innovation, nimbleness is a very big advantage, and we have the opportunity to do things differently, quickly, with new regulatory structures. They can make a massive difference to investment in clean energy. The meetings I've had since becoming Chancellor, I've heard of a wall of money that is waiting to invest in UK clean energy. And we just need to make sure that we unlock the barriers that are stopping that happening.
Part of the conversation we're having around subsidies is, of course, because we live in fast-changing geopolitical times, and we seem to be shifting from a world that suited Britain, a very global world, a world of globalization, to a world that is more multipolar. How does that sit with the UK's strategy?
I would say that the change that we're seeing in the world is one that is a worry for not just Britain, but for all democracies, because we're seeing the rise of more assertive autocracies who don't share our values and who tend to have a more mercantilist attitude to trade than we do. And we need to work together with people who share the same values to try and stop that happening. And I think we're more than doing our share of that in terms of our contribution to the defense of Ukraine. And that's important for business too.
You've talked about this not being the time for big tax cuts, but we understand that there are members of your own party that are still calling for tax cuts. Would it be idiotic to expect tax cuts at a time like this?
We don't have the headroom.
And I ask it that way, of course, because the Prime Minister said that the British people are not idiots and that they are not expecting to see tax cuts. So.
Well, I think people do understand that we're in a very challenging fiscal situation, that things haven't changed dramatically over the last 3 months since we delivered the autumn statement, which is only 2 months ago. We shouldn't expect there to be a huge change in the situation. But what I was saying today in my comments was that I recognize that lower taxes are part of the vital incentives that encourage people to set up businesses and to invest, and we want to go there. And the difference between us and the Labour Party is that Conservatives...
Of the Exchequer, Jeremy Hunt. Matt?
Anna, thanks very much. Anna Edwards there with Hunt, the UK Chancellor of the Exchequer. So very interesting stuff, and we're going to continue to pore over the details of the developing of the UK economy as they develop today. Right now, I want to get back to the markets and to the global chip makers. Shares around the world falling after Intel gave one of its gloomiest forecasts in its history. A personal computer slump has hammered its business, and at the low end of Intel's projections, revenue for this quarter would be the smallest since 2010. For more on the outlook for the industry, William DeGale joins us, lead portfolio manager for technology at Blue Box Asset Management. William, thanks so much for your time this morning. What has driven Intel to such a disappointing outlook? Have they just taken advantage of the negative sentiment to release what we would call a kitchen sink quarter?
Yes, there could well be an element of that. I think that Intel has, some major stock-specific issues. So you shouldn't read what's happening to this one company as representing the entire chip industry. Intel is in a very, very difficult position. As you suggest, maybe they're making use of a sort of general negative trend for other chip stocks to get some stuff out of the door. But I think mainly this is stock specific, and the PC market is clearly slowing down dramatically. That certainly doesn't help Intel.
So, William, what are the general boxes into which we who are not tech analysts can put chip makers? I understand that the PC industry has taken a huge hit, and companies that make chips for that segment are going to be big losers. On the other hand, there's still strong demand for companies who for chips made for automotive. So what are the main boxes or main buckets you throw chip makers into?
Yeah, so I think that the bucket that's really important, which you're alluding to here, is the stuff that's made on older equipment. So this is typically analog chips, microcontrollers, sensors. These are very sophisticated devices, but they don't need leading edge capacity. So they don't have to have the latest factories to make them. In fact, it's very difficult to make them. It's very inefficient to make them on the latest factories because shrinking these chips is very difficult. So you tend to have more and more sophisticated designs, but those circuits can't get very much smaller easily. They're essentially made on equipment that was new in the 1990s or early 2000s, and no one's been building 1990s capacity since the 1990s. And demand for this stuff has been slowly growing for the last 15 years or more. Because every time you have a digital computer interacting with the real world, whether it's in a car or your personal devices or whatever, it has to have at least one analog chip to interpret between the digital world and the analog world that we live in. And it probably has thousands of them. And that interaction between computers and the real world has been growing dramatically over the last 15 years. So the demand for this type of chip, which no one thinks is very important, but actually absolutely vital, has been steadily growing for 15 years, and the capacity is pretty much limited. And we've hit that capacity limit. That's what happened 2 years ago. And it's very difficult to add more capacity at this end of the market without changing the economics of the business. So the suppliers are unwilling to do it because they'd have to buy new machines rather than old second-hand machines, which have all been used up. They're all running in use. So that end of the market looks very different from the PC end, the memory end, the cutting-edge digital end.
That is absolutely, William, that is absolutely fascinating. How does that problem get solved? What's the solution?
So I think that the businesses that need these chips are going to have to pay more for them, and they have been paying dramatically more for them, but sort of on a one-off basis on the last couple of years. They're chips that were very cheap, trading for huge multiples of their face price on sort of brokerage, because they're in such short supply. What's really going to have to happen is that I think the price of this type of chip is going to have to rise to justify new expenditure. For example, Texas Instruments has talked about building its first new fab for a very, very long time. they'll have to be paid for that. They're not going to do that unless someone pays them enough money to justify it. Some of that money will come from subsidies from the US government, from state governments, from governments elsewhere in the world. There's huge subsidies going into this area. But some of it will have to come from the buyers. And I think that changes the economics for the trailing edge of the chip market, or the more mature nodes of the chip market. And that really is the really interesting bit for me. And you see this for things like ASML and ASMI results. So these are companies that make the equipment to make chips on. And those two businesses have been seeing surprising strength, not at the leading edge. It's come from the trailing edge, the older, the sort of deep ultraviolet or even older machines for ASML. And that's exactly what I'm talking about. The demand, the real tight bit is not the leading edge. It's the older equipment.
So what's the takeaway from Intel itself? What's the solution there? Because if they're posting sales as low as they did back in 2010, that seems almost unturnaroundable. How are they going to deal with this?
So I personally think they won't manage it. I mean, to be brutal, they've got an enormous problem. It's very difficult to see how they might succeed. And, this is an interesting punt for someone, but it's not a risk I'd be taking in my portfolios. They've got a huge issue. Their enormous advantage in the past was this vast array of enormous fabs, the factories they make chips on, which were the best in the world by quite a long way. And they were designs of the chips they were making were very good as well. But it was almost impossible for anyone to compete with them because no one else had access to this, unique production resource. But they got overtaken by TSMC a few years ago, and their competitors such as AMD and so on are now fabless companies that are paying TSMC to provide them with leading edge equipment, and the designs coming from these businesses are very good. So what was Intel's biggest advantage, this huge installed base of capacity, is now an enormous albatross around its neck because it's no longer leading edge. It needs to be upgraded, and that's very, very expensive.
William, thanks so much for your time. Really appreciate it. You managed to make the chip industry really, really interesting. So it's great to talk to you. William DeGale of Blue Box Asset Management, talking to us about really the big story in markets today, which is the terrible, horrible, no good quarter for Intel. And I think it's pretty ironic that we heard Jeremy Hunt, the Chancellor of the Exchequer, earlier say that he wants to make England kind of the new Silicon Valley, since Silicon is having such a bad day. Let's bring Anna Edwards back in after your interview there. Anna, Jeremy Hunt is positively optimistic. Why?
Well, he's the Chancellor of the Exchequer. That's often what you get, I suppose. But he's trying to make the pitch for the UK as an investment destination. The difficulty is for him, Matt, that he doesn't have many levers to pull. When you look at the Inflation Reduction Act in the US and the expected response from Europe, is there a danger that the UK gets kind of stuck in the middle with not enough firepower, given the limited room for maneuver he will have in terms of the budget? We'll hear from him around March time with more detail on the budget, but he was certainly bringing down our expectations that we'll get anything like tax cuts.
It does look like subsidies are going to be the answer for the US and for the EU in terms of green investment, but not for the UK.
Yeah, I mean, he was talking about the difference in timing there. Maybe the US has done less of it in the past, so maybe there's room for them to do more of it now. But that's certainly a conversation that's going to run and run very 2023. That is it for early edition. Surveillance is up ahead. They'll be hearing from PIMCO's Andrew Balls, among other voices. This is Bloomberg.
capturing most of your time and attention?
Well, we have a unique way that we look at big new investments, and I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? If we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
When we look at what's happening with the consumer, which is the backbone of the U.S. economy, we are seeing a clear loss of momentum.
Further deterioration in the labor market, we're starting to obviously get a flavor of that.
The danger is we have to go higher in rates, and it lasts for longer than what the Fed is even looking for.
We don't think they're going to cut by the end of this year. We do think early 2024.
It's going to be a recession, but a mild recession, so it's a hard landing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow in London, Lisa Abramowitz and Tom Keene on a Friday to get set for the weekend and a Fed meeting coming up next week. We welcome all of you here on economics, finance, investment, on John Farrow's tax bill in the United Kingdom. We'll get to him quickly here in a moment. The Chancellor of the Exchequer speaking at our Bloomberg offices in London.
Yeah, but still you're saying that John is responsible for some of the proposals out there. This is going to be curious to see, especially how much he's going to get some of the support behind him after the turmoil that we saw earlier last year.
Emily Ashton reporting on it for Bloomberg News. I love this idea, a catalyst for prosperity. I think that's a post-Brexit angle. We'll talk to Anna Edwards about this here in this half hour after a conversation with the Chancellor. I'm going to look at the data here, and I don't know what to make of it other than what is this week? The surprise for the bears, equities up. All week is the key word.
Let's tie the two ideas together, what Jeremy Hunt had to say, the Chancellor of the Exchequer over in the United Kingdom, and what we're seeing in markets. It is money out of the U.S. and to everywhere else. It is to Europe. It is to emerging markets. We saw nearly record flows to the emerging markets, to Europe. How much can that continue, given that this really has been the pain trade for the past decade? Is this something that can be sustained?
I want to get to John Farrow here very quickly with his important guest, Mr. Oppenheimer of Goldman Sachs. Let's run through the data before the brief. Lisa, to me, the headline item, the VIX under 19.
The headline item for me is start with weakness, end with some gains, and that's been really the theme of the week, that even if you do see potentially negative news, the market can rise above it by the end of the day, given the rally that we saw yesterday.
3.54% on the 10-year yield. 2s gives me nothing. Real yield 1.21% as well. Dollar churning, maybe dollar a little bit weaker here. We got to go to sterling, 123.75 before a sterling brief on a Friday morning.
So yesterday, after the bell, it was all about Intel and the earnings that came out that were highly disappointing for a lot of people. Those shares are down. Today, the earnings, yes, and just to sort of push it forward, today we get Chevron and American Express before the bell, but this is all just the lead up to Apple, Amazon, and Alphabet or Google, which all come out Thursday next week. We're getting the real economy this week. We're getting the tech economy next week, and this really is going to be key in determining the path for the index going forward. 8:30 a.m. is the data dump that we've all been waiting for. U.S. personal income spending and core PCE PCE, core PCE, I keep focusing on that. How much do you see it decelerate? Yesterday, it came in pretty much in line with the quarterly look. How much does it actually decelerate and give the Fed some reason to follow what the Bank of Canada did and really give a little bit of a dovish tilt? And at 10 a.m., University of Michigan Sentiment Survey, what's good news and what's bad news? If it inflects upward, is that good, or is that basically signaling that perhaps the economy isn't in such dire straits as people are expecting to get this soft landing? I'm curious to see how people interpret, how the market responds to a survey that has been inflecting negative for a while.
He was in London and was seen in the corridors with the Chancellor of the Exchequer. Ashton and Wickham of Bloomberg News report the Chancellor of the Exchequer, Jeremy Hunt, dismissed calls for tax cuts, warning that John Farrell must pay his fair share. Joining us now from our offices in London, John Farrell. John, your accent is changed this week. It's worse than normal.
Just to be clear, I am funded in dollars, Tom, for the 10th time, and that's where I pay taxes as well. I want to clear that up. And for the second point I'll make, Tom, the Chancellor was only here to warm up the seat for Peter Oppenheimer of Goldman Sachs. Peter joins us right now, the Chief Global Equity Strategist. Peter knows that. Anyway, Peter, you're a popular man this year, and good afternoon to you / good morning, I guess. European equities, that's what it's all about. It's conference season. When you go around doing these conferences, do they buy the hype in Europe after hearing it for the 10th time in the last 10 years?
Very slowly, people are warming up to it, and it's been a long time coming, I know that, but performance attracts investors, and we've seen, a 30% rebound in the European market since October, at least in dollar terms, and that is starting to energize a bit of interest in the region, and it reflects the big shift we've seen towards value. Again, something we haven't seen now for more than a decade.
So clearly we've priced out recession, we've priced in stagnation, and investors are focused on the difference between the two. I get all that, but now we need to talk about the difference between stagnation and real recovery and expansion, and that's been a theme for us this week. When do we start to focus on the fact that there is no growth in Europe? It's just an absence of a recession, and what we've seen so far is a bit of a squeeze, a relief rally, and perhaps nothing else.
Well, I think we need to put it in context here. We think that the global economy is in a relatively good shape, and we expect to see a soft landing in the US, but we also now expect to see a relatively soft landing in Europe. The falls in gas prices have helped, the pickup in China as well. But the absence of recession, as you say, doesn't mean we're yet into a strong recovery cycle. And I think the rebound that we've seen in risk assets in the last couple of months is overstating the potential from here at the index level. We've got flat returns in the US this year, slightly positive returns in Europe, so we prefer Europe. We think most of the action is going to be below the surface of the index.
Well, let's talk about those opportunities. Banks have ripped in Europe. They're up about 50% from the July lows. I picked out a minor because I know you like some of those names as well. Rio since October's up something like 40%. These are huge monster moves. And credit to you guys, because you got on board this banks trade in Europe at a time where I was sitting there thinking, you've got to be kidding me. We're going to get rate hikes from the ECB. It's going to crush the economy and peripheral spreads are going to blow out all over again. Why has that trade worked? And why do you think it will continue to work?
Well, I think there are three things. First of all, the recession that people feared 6 months ago is not happening. There was a point where the market was pricing in quite a big downturn in the European economy. The expectations there are adjusting pretty quickly. We actually have 0.6% GDP growth across the Eurozone this year. So the economy is growing, not shrinking. That helps a lot. Second of all, the rise in interest rates we're seeing is material, given where they came from. Remember, just a year and a half ago, 25% of all government debt in the world had a negative yield. Now that doesn't exist. European rates were negative. Now they're positive. The leverage to that in terms of net interest margins is the real game changer. And bear in mind that corporate balance sheets are reasonably healthy. So loan losses and the risk of a big downturn hitting banks is just evaporating. And the third factor is they were just really cheap, and they remain pretty cheap. They're cheaper now when you look at the multiple relative to the market than they were even during the sovereign debt crisis.
We started this conversation by you talking about how challenged the index level is. We've talked about that a lot in Europe. The absence of tech in Europe as a big weighting in the overall index was seen as a weakness for a long, long time. Is that a strength this year? Because I'm looking at the year-to-date performance of some of these tech names. Lisa was just going through them. Those tech names in the US, despite everyone saying it's game over, they're flying year-to-date. Is the absence of big tech in the index in Europe a weakness or a strength?
Structurally, it's a weakness because there is going to be more growth in the tech sector. It's going to remain the most important driver of growth, I think, for the next decade. The constituents are likely to change over time. That's always been true of technology in the past. You'll get new innovations which will generate higher returns. And so I think it is a problem in a way that Europe doesn't have many big tech names. But of course, the recent rally we've seen in tech is partly because of this rally, again, in bond yields, interest rates coming down because of fears of inflation moderating.
Yeah.
And that's helped the longer duration parts of the market. I think really the whole concept of being in growth or value, which was really driving the markets over the last decade, is not really the story anymore. I think you need to have a much more eclectic mix, including deep value areas like commodities and banks, but also companies that can sustain stable margins and earnings. And some of that will be in the tech sector as well. Europe does have many of these, maybe not specifically in technology, but our group of what we call the granolas, the 10 really
which you've
big,
talked about before,
super-sized companies in Europe, which are mainly in areas like consumer staples, luxury, healthcare, and some technology. These companies are about a quarter of the index, and they're still growing because they're generating stable margins and very strong cash flows, and I think they'll continue to do well.
I've got time for one more. It's interesting to me that the market always seems to dictate the stories we talk about. Price, shapes, sentiment, you know that. And the headlines often come about from where the market is on any given week. And clearly we've rallied year to date in Europe, and clearly we've rallied over the last couple of months, and clearly we've priced out a recession, and clearly off the back of that, the conversation and the tone of the conversation has changed. Being here in London this week, you can't escape the fact there is still a war in Europe. And for many reasons, based on what's happened over the last month or so, there are reasons to sit here and say that war has the real potential of escalating again. I understand we've escaped what could have been a much, much more brutal winter on the continent. I'm just wondering this hour, and I'm going to have this conversation with Amrita Sen of Energy Aspects in about 40 minutes. How long before we start worrying about next winter in Europe and what is actually happening in Ukraine?
I think you make a very good point. Part of the optimism that we've been seeing priced in is based on the collapse in gas prices. That reflects really two things: a very mild winter, which we can't assume will be repeated next year, and all supplies. And as China recovers, and Europe needs to restock its gas supplies at probably higher prices, that issue will come back. And that's again why we're slightly more tempered in our optimism about the pace of the recovery at the index level over the course of this year, not just in Europe, but across equities overall.
Peter, this was great. We're going to make it up to Manchester this evening to watch Arsenal Man City. Is that happening?
But you're going.
TK's trying to make it happen for us. It's amazing, Tom, how easy it is to get tickets over at Manchester City still, the Etihad. You know what they nicknamed that stadium, Tom? The Etihad, the Empty-had. Still.
Really?
It's that easy to get tickets for Manchester City.
Why does no one show up to
see?
Why does no one show up to see that magnificent team? I'm serious. I mean,
I'll let Man City fans speak for themselves, but I can tell you, Tom, last weekend when I tried to watch Arsenal versus Man United, almost impossible to get a ticket.
Yeah.
This week, looking at Man City versus Arsenal, very straightforward, very simple.
Well, it's a great country. You've got a train ride there 2 hours and 3 minutes, John. That does not happen in America. John Farrow with the wonderful Peter Oppenheimer in London, and an important interview coming up with Amrita Sen. We're going to pause the program right now, and Lisa Bramowitz and I are going to go all engineering tech. Lisa, Intel 4 failure, Apple A13 Bionic success. That's really what this is about.
That big tech is not monolithic. You're seeing real divergence, and Intel really highlights that, especially with even other chip makers doing okay this morning.
It's going to be interesting. JP Morgan, their price target on Intel, along with a lot of others, $32 down to $28. Stay with us from London, from New York. This is Bloomberg. Coming up, Anna Edwards.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. Bloomberg's learned that Vladimir Putin is planning a new offensive in Ukraine. The Russian president is also preparing his country for a conflict with the U.S. and its allies that he expects to last for years. The Kremlin wants to show its forces can regain the initiative after months of losing ground. It's hoping to force Ukraine and its backers to agree to some kind of truce. The International Monetary Fund is considering an aid package for Ukraine worth as much as $16 billion. Bloomberg's learned there are still a number of conditions, including endorsement from the Group of 7 nations. Ukraine's government would also need to commit to a series of policies. Bloomberg's learned that Japan and the Netherlands will join the U.S. in limiting China's access to semiconductor machinery. The alliance is aimed at undercutting Beijing's ambitions to build its own chip capabilities. U.S., Dutch, and Japanese officials are set to conclude talks as soon as today. A new survey of economists says the European Central Bank will go for 2 interest rate hikes of 50 basis points on its way to a May peak. Then, according to the survey, the deposit rate will be held at 3.25% for about a year. Economists expect a struggling economy will eventually lead the ECB to cut rates. And more losses for Asia's richest man. The sell-off of Gautam Adani's corporate empire accelerated on Friday, erasing more than $50 billion of market value in less than 2 sessions. The fallout from a report by Hindenburg Research has investors keeping a close eye on the $2.5 billion share sale by Adani Enterprises. The Adani Group disputes Hindenburg's allegations of corporate malpractice. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Season is here.
Big banks, that was the big story.
From the big banks to big tech.
Everybody is losing a lot of money.
It's a question of how high the bar is set.
Bloomberg breaks the numbers first.
A blockbuster number. Blowing through estimates.
These guys are minting money.
With exclusive expert analysis.
Does this approach make sense to you?
We're going to have to make an acquisition.
Does this quickly become just a really crappy business model?
I don't think their business is as broken as the world thinks.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The first thing we have to do is the Prime Minister's plan to halve inflation. That is going to require patience and discipline. When we are able to, no one wants to cut taxes more than I do, but we have to recognize this is the priority for business as well as consumers right now.
He is the Chancellor of the Exchequer of the United Kingdom. His name is Jeremy Hunt, and particularly for Awaking America, how do you know him? He is the gentleman that made the best Olympics in ages work. He is the guy who did the London Olympics. He is expert at organization. Also expert at organization, always in London, is our Anna Edwards, and joins me and Lisa Abramowitz in New York. Anna, let me just start with a basic view from 60,000 feet. With your coverage of Downing Street, with your coverage of the Bank of England, you're truly expert at this. How's that Brexit thing going? Is the Chancellor happy with the experiment of Brexit years down the road?
Well, he was not one of the people who voted for it. Good morning, Tom and Lisa. He was one of the voices that warned against it, but he's turned his view around, as many in the ruling Conservative Party have done. He was talking about the virtues of it, the freedoms, and there is one. Getting rid of some rules around insurance means a whole pot of money in the private sector that will be able to be invested in green technology. So that's a sort of tick for the things that Brexit allows the UK to do. But on the other side of the ledger, there are plenty of voices saying, hang on, investment is below G7 levels. There are plenty of headwinds against the UK economy, and some of those can be attributed to Brexit. Investment is one of them. The CEBR says that the economy is 5% smaller than Brexit. So maybe the jury's still out on that one, Tom.
Well, the jury's still out there. You know, Anna, when I come to London, I go deep into the west, call it Heathrow. I go way north, you know, up by Euston and the rest of it and all that. I don't get into the rest of the United Kingdom. How is the Chancellor and his party doing outside of London across all of the United Kingdom?
Well, we have a nifty little phrase for all of that here in the UK. This is levelling up. This was introduced by this government, this phrase, and it basically means trying to rebalance the economy from the heavyweight that is the southeast, the place that you frequent, Tom, when you visit London and its surroundings. Try and rebalance some of those growth opportunities around the country. And frankly, based on Bloomberg analysis, the government is not living up to its own commitments around levelling up. They set out a number of criteria that they wanted to measure themselves on, and of course, the pandemic and a whole load of other things got in the way. So that one is still a work in progress, trying to bring opportunity to other parts of the country.
Anna, how cohesive is Jeremy Hunt's message at a time when they really don't have the money? They can't necessarily raise taxes. They're not going to cut taxes, but fiscally, there's a lot of constraint there. And they're facing off with Europe and the U.S. that are pumping money into tech, that are pumping money into segments of their economy that they think will grow a lot.
Yeah, absolutely. A real shift in the geopolitics surrounding the UK right now. So the UK is now outside the European Union. So it's not at the table when the Europeans have those conversations about mobilizing 400 billion euros worth of 300 billion euros worth of money to take on the Inflation Reduction Act in the US. The Americans mobilizing, as you know, $400 billion worth of funds. So in amongst all of that, what does the UK do? The UK doesn't have that kind of firepower. His answer is that businesses don't just want subsidies. Subsidies are not the answer. They're concerned about the IRA, as you call it. And he thinks that other things will attract business to the UK. That's his pitch.
Do you get the sense that things are more stable, that we're not going to see a redux of what happened last year?
They definitely have done a lot to try and turn the page on that one. I mean, I think that there are still limits on the maneuverability of the budget, for example. That's coming up in March, that will still have hangovers of what happened in September, October. That mini budget really marking the UK out as something that people had not expected on the international stage from an investment perspective. So there's still that legacy that they still have to deal with, and that still ties the hands of a government that is facing strike action and would perhaps like to spend a little bit more on people's salaries, but they have limited room to maneuver right now.
And I'm fascinated by the relationship, and this is after, you know, my distant view of the tumult of Prime Minister May, Prime Minister Johnson, Prime Minister Truss. What a sense of chaos. And yet we would look at the city as just moving forward effortlessly. What is the relationship of this Chancellor of the Exchequer with London's Wall Street?
Well, I mentioned the freeing up of the money post-Brexit that's on insurance company balance sheets. This is called Solvency II, if you look for it in the literature. And if you remove the UK from the Solvency II regulations, the argument is there's a lot of money to invest in private sector activities, such as greening the economy. And the UK's Wall Street, as you put it, likes that quite a lot. So they like that stuff. There's always some tension around passporting and the post-Brexit reforms and the city not getting what it wanted out of the aftermath of the Brexit conversation. But we have been through leader after leader, and there has been plenty of turmoil, and yeah, somehow the city manages to keep its head.
And one final question, if I could, and that is, what is the opposition doing? John Farrow's explained to me 4 times over a beverage of my choice the British election cycle. I still don't get it. But does Labour have a dramatically different Chancellor of the Exchequer view, or is there a solid middle ground, maybe like there were in the Blair-Brown days?
Well, that's an interesting question. I mean, 2024 is when we get the next election, and the important thing to note is the massive gap between the two parties in the polling. So post the mini budget, post the chaos of the aftermath, the downfall of the Boris Johnson administration, the Labour Party, the opposition, has opened up a massive polling lead, 20 percentage points at some junctures. That is huge. That's not very common in British politics. So that is something that everyone is looking to. And it's the fact that we don't have an election this year, perhaps, that means we're not going to see any of the tax cuts, and that was Jeremy Hunt's message today. But we wouldn't necessarily rule them out before we get to an election in 2024.
Anna Edwards in London, in conversation with the Chancellor of the Exchequer, his remarks at our Queen Victoria Street headquarters today. Anna, thank you so much for that leadership, and look for that out on Bloomberg Digital as well. We spent so much time on the clear and present danger, John traveling to Manchester, that, oh yeah, there's markets out there, and there's a stagger into the weekend. Lisa, how are you setting up for weekend reading and into a Fed meeting week?
Has this rally gone too far? Has the optimism gone too far? Have we already priced in all of the gains that people expected for the rest of the year? And how will we know? And honestly, how much can we see this feeling that the Fed's going to pull back from some of the rate hikes that previously were expected, given some of the momentum that we keep seeing in a lot of the underlying data?
I agree. And what's fascinating to me, and it can be any different chart, equities, bonds, currencies, commodities, everything's sort of up as a general statement, at resistance, as the technical people would say. And the answer is, what's the breakout? What's the catalyst to leap up? And the one insight I could come up with is I've got too many people sitting to my left modeling out 3% inflation. And I find that just, we're not there yet, and they're saying we're going to get there.
And some people being even more aggressive, saying we're going to get down to 2% by the end of this year. Next week, the tech earnings are going to be really key, not only with what they're seeing on the ground, the bifurcation. We talked about Intel, for example, on one side and Apple on the other. They're doing very different pictures. Even Taiwan Semiconductor Manufacturing, they're doing okay. They're doing better than good, with Intel still flat on its back. Well, so a real bifurcated picture here. How much does tech give us a sense of what's coming up and their ongoing dependence on China?
A lot of people writing on Apple sort of as the bellwether next week. I guess it's got to be. It's the biggest stock in the solar system, or at least the focus here. I know Jim Suva over at Citigroup paints a constructive picture, but also Mr. Suva and others, this complete mystery of the flows of Apple with Apple's China. Nobody really knows.
And how much they cannot extricate themselves from this nation. I mean, again, we have a lot of public officials, whether it's in the U.S., whether it's in Germany, making noise about, creating a bigger fissure between the U.S., between the West and China. It's not happening when you take a look at these companies. They are dependent on China, and you're seeing that really double down, especially with the reopening of China and the potential consumer spending there.
I'm going to go back, and of course, in this day of a generational shift to Toyota in Japan, not betting on the Pacific Rim is a hazardous process.
Well, it certainly has been
over
this year.
Many decades.
I mean, so far.
I can understand Apple continuing with the China discussion, even if many others don't. Futures at -9. I'm going to call it a churn to the market. The headline, the VIX under 19. It is some form of bull market. George Borey coming up. He's chief investment strategist at Allspring. Stay with us on a Friday. This is Bloomberg Surveillance. Good morning.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Bloomberg Surveillance. Good morning, everyone. Lisa Abramowitz and Tom Keene in New York. John Farrell with an accent change in London. Do you agree with me? Like, I can't, usually I can't understand like 1 out of 5 words, and I think we're down to 1 out of 4 words.
Okay, come on. You understand him. He's perfectly understandable to anyone. He's sort of more universally understandable than I am. But I will say that it's really hard to go somewhere and not start to adapt to
the language
accent a little bit. Yeah.
well,
I mean, honestly, it's easy to make fun, but it actually, it's hard. You know, you reflect what other people are saying. I'm just saying.
I don't have a life, so I don't go anywhere, so I don't know what that's like. But I know when you were in Fargo of the Dakotas, your accent changed as well. John Farrell, Amrita Sen coming up on oil, and I'm going to get your attention. A data check, Brent crude, $89 a barrel. The first thing I checked this morning was a 90 print. We're not there yet, but this is a backdrop this week, is a lift, to say the least, in oil. Lisa, I'm sorry, a gallon of gas, however you want to frame it, all of a sudden, it's a February topic.
I'm so glad you brought this up. Gasoline, $3.50 on average nationwide. Still pretty low, but the low at the end of last year was just $3. So it's just marginally creeping up pretty steadily at a time when a lot of people expected this to bleed into the consumer spending appetite.
Red on the screen, it really hasn't rebounded, but every day this week we get red on the screen and then boom, up we go with some form of bid. The VIX 18.87. Yields giving me some discussion, 3.56% on the 10-year yield, 4.22%. Higher yields all in all, but don't want to make too much of it. Who does make too much of it is George Bory. He's Chief Investment Strategist at Allspring Global Investments, and thrilled he could join us this morning. Do you have to rewrite your strategy on January 20 whatever versus what you wrote on December 28th?
Good morning, John. Good morning, Lisa. It's great to be on the show once again. Not at all, John. In fact, much of our strategy was written back in November in anticipation of a January print. So as a strategist, I'm pretty happy about sort of where we are, at least cyclically, where the markets are. And we did expect a kind of a better start to the year. But the central message from us is that for bond investors, it's still a pretty good environment. You know, growth is coming down. It's slowly coming down, still pretty good, but coming down. Inflation's coming down. And as we'll see next week, you know, the Fed is still very much in tightening mode. This is the polar opposite of where we were 12 months ago. And for bond investors, that's generally a pretty good thing. And you pointed the 10-year. 10-year's been chopping around 3.5%, and we're likely to be there for a while.
George, help me. John Tucker and I used to do a wonderful thing in the radio studio of the opening of his 401k envelope. And Tucker informed me the other day it's become a 201k due to bond losses. What does Allspring and the representation of the Wells Fargo family across this nation, what do you advise as a strategy for people like John Tucker that have been blown up last year in bonds? They need to recover, but they don't want to buy Apple Computer. How do you recover in the George Bory space?
Well, bonds can do what they're supposed to do today. And if you look at where bond yields are and where we got to last year, the downside, obviously, of a meaningful repricing is your mark-to-market's gone down. The bond yields, the income that you can earn has gone up substantially. But bonds can basically do what they're supposed to do. Number one, generate income. Number two, provide you with a buffer against future volatility. And number three, we do think bonds' ability to provide diversification, it's coming back. That extra income, that higher coupon, it will provide some buffer against, sort of correlations as we move forward. So you're not going to earn it back in 1 year, but you will earn it back. And making sure that you're positioned appropriately on the curve so that you can compound your returns as you move through time. When we look at yields, we can build portfolios anywhere, average yield somewhere between 4 and as high as 8%. That's actually a relatively attractive opportunity for bonds. There's good cash flow generation there. And importantly, there is the potential for some capital risk, capital appreciation. We don't really have that penciled in all that much for this year, a little bit of duration, so we think prices can go up a little. But as I mentioned before, the 10 years right around 3.5%. We think it's going to be there for most of this year. Lisa's talked quite a bit about credit spreads. We've seen them rally actually year to date. We're probably going to give a little bit of that back. But what we tell bond investors, 80-90% of your return comes from carry, it comes from income. That's what a bond is supposed to do. It's generate a very predictable, very precise, and very manageable stream of cash flows. If you're using bonds to do that, even the ones you bought last year, they're still doing that. The price dropped, but they're still generating the income that they were supposed to do when you bought them.
Basically, this is a way of saying they're supposed to be boring. They should have been boring last year. They should be boring this year, but they're getting back to it, and they can provide that kind of benefit to a portfolio. How much of a liability is the fact they've been anything but boring? The incredible down market, the bear market in bonds last year, led by your area, the safest aspects of the credit markets. And then this year, they're behaving like equities. Does this bring in tourist flows and create more volatility just sort of inherently for the asset class for a longer period of time?
There's a big rotation going on in the market, Lisa, and that's a really good point. Bond investors, we brought a lot of tourist investors into the asset class as bond yields came down structurally over several years. What you're seeing is a very big rotation in terms of demand. Retail demand, we have seen a little bit of a pop early in the year, but where you see the biggest form of demand is coming from the institutional side. These are pensions, they're endowments, they're insurance companies, they're large institutional investors who buy bonds with very specific liabilities that they're trying to match against. This is where we see the greatest amount of demand. The other is just sort of globally, where is demand coming from? We've historically, or at least over the last several years, tremendous demand from overseas. That's pulling back as the dollar sort of weakens in here a little bit, but we're seeing a nice uptick from domestic investors. If you look at the pension industry, sort of funded plans are as high as they've ever been. So that sort of rotation from equities into bonds is a structural move that we're likely to see throughout the course of this year.
So let's put some numbers on this, George. Last year, investment-grade corporate bonds in the U.S. lost 16% all in total return. So this year, could they gain 16%?
It's unlikely. I think the realistic sort of returns for, say, an investment-grade bond over the course of the year, we would sort of pencil in conservatively sort of mid to maybe high single digits. So if you could claw back half that loss, there's a good probability that happens. 16% would be a massive recession, major drop in yields, and bond yields for corporates coming down as well. That's not our central case.
George, I don't mean on a pension basis or a CFA level 3 basis, but to our listeners and viewers, I believe we've had a great moderation. We've had a massive medical issue in COVID, in pandemic, and ginormous swings in what inflation will do. Have you adjusted a casual actuarial assumption that all of us need to assume? Do we need to save more because our total return over the next 10 or 20 all-spring years is going to be lower?
We think structurally, sort of returns more broadly are going to be lower. And it's as inflation's gone up, as you pointed out, we think inflation will stay higher structurally than what we saw over the last decade. On top of that, Fed policies moved up. It really means that, sort of the cost of capital is going to stay structurally higher, and that will keep sort of overarching returns lower perhaps than they've been. That goes back to the story about bonds. Why are you buying them? What can they do for you? If you're compounding your portfolio at say 4 to 8% a year, that's a very desirable sort of return level with relatively limited volatility. Our vol shock was last year. That volatility should come down as we move forward, and that will help your bond portfolio both be accretive to your overall wealth, help grow your wealth portfolio, but then also, as I mentioned, that buffer against other things we think comes back in vogue as we go through this year and into next.
George, I'm so glad you went there because the volatility aspect is where I wanted to go. And Tom was asking me what the reading was over the weekend that I wanted to do. It was very much about have we gone a little bit too far and gotten too complacent with this idea that we're not going to get volatility again in benchmark rates. How much are you watching the roll-off in the balance sheet for the Federal Reserve and the potential that they go beyond what the market is expecting, try to shock the market into perhaps a bit more of a tighter financial condition, and that this actually disrupts this thesis of a lack of volatility?
Well, I think it means that vol, again, it's been coming off the peak. So we had an extremely volatile year last year, as in all markets kind of repriced to this structural higher inflation environment. As that sort of that shock value of that experience comes down, vol comes down with it. So if the Fed is going to moderate its pace of rate hikes, that's a good thing from a vol perspective. We know that there's QT happening in the background, so that will add some vol. So vol will remain elevated. It will just not be at extreme levels like we've seen. That means risk premiums, broadly speaking, have rallied, but they're not going to rally back to those extremely tight levels that we saw. Again, it all goes back to that increased sort of risk premium that's built into the market. As an investor, you can take advantage of that. Our view is that the economy is slowing, but more importantly, there's a massive rotation happening within the economy. Inflation is not universally a bad thing. Many companies, we just saw nominal growth last quarter, 9%. I mean, that's a pretty punchy economy. There are beneficiaries to that type of environment. As a bond investor, I can take advantage of the volatility, rotate my portfolio to focus on the winners. Nice bottom-up analysis and really sort of capture that yield as we go forward.
George, thank you so much. George Bory of Allspring, always informative, particularly on the bigger picture towards retirement. And, I'm sorry, as you know, I'm never going to retire. They got the surveillance casket out back. But Lisa, there's the Chancellor of the Exchequer before speaking with Anna Edwards, and he cuts to the social policy Mr. Bory was just talking about on retirees in the pandemic. He says to retirees, get back to work. Quote, I say Britain needs you. And we're going to see that in America, too. It's like, let's go, pandemic over, and anybody with gray hair and a bow tie can't retire.
Well, and it goes to the structurally longer inflationary push that goes beyond just pandemic spending, because if people are retiring, if people are pulling out of the workforce, well, then you've got a labor shortage, and you're seeing that across the board. And so how much does that keep inflation sustained? You know that I saw this story on the terminal this morning that people who work for central banks, the Fed and the ECB, are complaining that they're not getting wage increases in line with inflation. So even the central bank workers are saying, hey,
well, that's
wait a
part
second,
of the retirement
this is part of the issue. Yeah.
And it's part of it. There's a whole actuarial assumption that nobody thinks about this till they're 42. So you're years away from worrying about retirement. But the bottom line is we underplay this in the financial media. George Bory's living it at Allspring. This is a huge deal. I mean, as the Chancellor says, get back to work.
And if you don't
retire,
then all those central bank workers will say, wait a second, everyone else is getting wage increases. I want to get them too.
Email from London. John says, really? Okay, thank you, John. John Farrell coming up on oil with Amrita Sen. Stay with us here, red and green on the screen. The VIX, 18.86.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The UK's Chancellor of the Exchequer, Jeremy Hunt, dismissed calls for tax cuts. In an exclusive interview with Bloomberg TV, Hunt said that sound money must also come first. He was asked about so-called green subsidies.
Well, we think that if we're going to have the transition to net zero, we should benefit from free and open trade. between all the countries that share that ambition. But I don't think subsidy is necessarily the best way. I think what people want is creativity, innovation, ideas, a climate, a regulatory structure that encourages investment.
Hunt also pitched the UK as a hub for high-growth, high-tech industries and innovation. Well, it's been almost a year into an invasion that Vladimir Putin figured would be over within weeks. Now, Bloomberg's learned that the Russian president is planning a new offensive in Ukraine. He's also bracing his country for a conflict he expects to take years. The Kremlin wants to show its forces can regain the initiative after months of losing ground. The idea is to force Ukraine to agree to some kind of truce. Goldman Sachs warns that the next sanctions on Russian oil are likely to be more disruptive. The new penalties take effect next month. Among other things, they'll impact diesel fuel. Russian diesel exports account for 15% of global flows. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Seeds, typically between the time you start and they get out in the farmers' fields, is about 8 years. Now we have a pipeline of innovations. We've been funding the CG system for 20 years now. It's funded at about $1 billion a year. If people care at all about adaptation, that thing will be funded at $2 billion a year. I mean, there won't be anything close to the impact of climate-related seeds, climate-related maize, rice, wheat, sorghum, millet. And thank goodness, because of human genetics, we know how to do the editing. Thank goodness, because of AI, we know how to find the alleles. Because of drones, we can measure stuff in the field. So there's huge advance in terms of how the whole seed ecosystem moves at full speed.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
This is Bloomberg.
Refinery capacity is down about 8% relative to where it usually is this time of year, and that's putting some of that squeeze on gas prices. Perhaps more exporting of refined product from China and other exporters could help in that regard. But you do have to look at the refinery situation to understand the near-term movements in the gas price, which still, by the way, is down about $1.40 since its peak last summer.
Jared Bernstein there with the White House, very important and a really sane voice on financial matters there on hydrocarbons. And right now, Lisa, a large hydrocarbon company reports, Fortress Worth reports.
Yeah, Chevron, after saying that they're going to buy back $75 billion of the shares today, reporting fourth quarter earnings that are below expectations. Adjusted earnings per share in the fourth quarter, $4.09 versus $4.27. You do see a move marginally lower, 42 basis points lower, less than 0.5% after yesterday's nearly 5% gain. So perhaps this is a story of share buybacks and dividends exceeding any sort of slight disappointment